to play some of those opportunities. Even I can understand the intent of the government, given the policies around the world. But we also, from an investment standpoint, need the vehicles, which we have in areas such as other parts of the market infrastructure, and what are the things that you called out: railways, ports, etc. But we don't have an adequate measure in some of the others. So I think that is still some time away. I think for us, India, it is basically the diversity that India offers. So, I mean, more than so that's why, as and when the attention from AI becomes a little softer, and I don't expect even AI to go away anytime soon, but we get that window of opportunity where diversity comes about, and asset managers around the world start to rebalance their portfolios.
Tahir, before we let you go, our next discussion is on real estate with a real estate company, Prestige. We'll have Mr. Razak join in shortly. But I want to get your thoughts, because this is one more sector that's a little confounding. When you talk to the developers and when you see their numbers, and all of them have had an actually pretty solid last couple of quarters, right? Pre-sales have been good, collections have been up, pricing has either increased or has been stable. But the stocks have languished. The Nifty Realty Index is almost 19-20% off the peak. So what's going on here, and what's your sense on this part of the market?
No, absolutely fair. And I think that is another part which I forgot to mention is a reasonably important element of our portfolios as well. And we've lived through it. I think we've enjoyed the fruits of it as well 2 years prior. And the last year has been somewhat slack across the sector, but that's understandable after a very strong rally. But I think generally we feel that this is still a segment which where the growth cycle is relatively more sustainable. I mean, we've seen real estate generally has long cycles, as we all know, 10 years up, 10 years down. That kind of a thing, and we are probably still in mid-cycle zone, and we've a good part is that stocks have corrected. So actually, we will see momentum start picking up once again. There is we from a more longer term standpoint, we believe that the biggest driver of real estate is essentially the fact that we're going to see a significant migration from low middle income households to upper middle income households. As you look at it on the income spectrum, and that is a once in a lifetime event in any country. In any country's history, and India is already in that process, but it is only going to get bigger and bigger. So we are going to see probably almost 20% households move from low middle income to upper middle income, and that is essentially what is going to drive a lot of the real estate demand. And we are also in the midst of an upgrade cycle as far as real estate is concerned. Everybody wants to premiumize as far as the housing is concerned as well. So I think it's relatively more sustainable, and especially in an environment where interest rates are make it more affordable. And so I would like to think that this is something which should come back. That is one of the sectors which we hope will be a cyclical recovery in 2026.
All right. Thanks a lot, Tahir, for joining in. Wishing you a good day ahead. And hopefully the next time we chat up, the broader markets will be participating as well. For today, we're celebrating the Nifty at all-time highs. Well, Prashant, just one quick point on what you said. The state government push. When the management push comes about, a stock like GMDC, for example, we here at CNBC-TV18 had explained the prospects in 2022, June. A viewer's, in fact, just written in. The stock was around 150 rupees. It had cash in its books, but the intent of the management wasn't there. And you couldn't reach the management for many, many years. Suddenly, you had a change in management. Mr. Gupta came in, Mr. Singh came in at the top as well, and that's where the fortunes started turning as well. So the intent to create wealth as well is something that's very, very important, and communication with the street is something that the street tracks.
Nigel, the point is, and I spoke to yesterday somebody, I think Nimish also tracks this one closely, and the point is, and I think it's still, you got to get this stuff out of the earth, right? Now the mineral is the stuff is there under the ground. You got to take it out, right? That's essentially the thing, and that's 3 years, 4 years out. Yeah. Now the point is, rare earth processing is a different matter. Yeah, that is a new industry you got to set up. Yeah, that will take time. Yes. So that, I think we've got a chat coming up, and we'll try and understand. But the point is, can this be fast-tracked with the centre now coming in and putting in a policy that we've got to develop this industry in a big way? I think that is the question for a company like GMDC, and we'll try and understand this, and we'll try and get GMDC, the company, on the channel once again. We'll take a quick break. 70 points higher, 26,275.
I think before we...
I think Hormuz is with us, right? Yeah. He's standing by. He's prepped the data on where markets are, stocks more importantly are, September 24 and where they are now, even though the index is back at those levels. Hormuz, take it away.
They say sabar ka phal meetha hota hai. It's taken 14 months long of sabar to get to where we were back in September of 2024. It's, of course, the record highs for the Nifty in today's session. And from the lows that we made this year, which was on the 7th of April, we are up 19% from those levels. You look at the stock contributors as well, among them, starting from the 27th of September. You look at Eicher Motors, BEL, both of them up over 40%. Bajaj Finance cooled off from the highs, was among the top gainers, still up 30% from over the last 14 months. And making a move also is SBI and Bharti Airtel, gains of 23% each. Now, the list of underperformers also is a list of some big names. Bajaj Auto, incidentally, also made a record high on the 27th of September 2024, is down 30% from those levels. Trent has almost halved during this period, and also making a move here are Coal India and TCS on the downside, losses of well over 25% each. Now, if you take a look at the movers from the April lows, some similar names here. BEL finds a mention here as well at 53% from the lows in April. Mahindra & Mahindra, Eternal, Jio Financial and Eicher Motors here as well. Gains of well over 40 to 50%. But you look at the sectoral indices over the last 14 months. Banks have been the big contributor to this move. The Nifty Bank already at record highs is up 11% during this period. The auto index hasn't done much. IT, the other big sectoral weight, has somehow offset the moves from the banks. The pharma index hasn't done much, but the bigger underperformer compared to IT has been the FMCG index. That's down 16% over the last 14 months, and the metals index too is up only just 2%. But if the Nifty is at record highs, the broader markets have done precious little during this period. The midcap index is up only 1%. The small cap index, in fact, is down 7% over since September of 24. You take a look at the movers in the broader markets. You look at BSE. The stock has more than doubled, in fact, almost 2.5x from that period. Paytm is up 90%, still, of course, below its IPO price. Muthoot Finance hitting new highs. Indian Bank, among the PSU banking names, is up 64% during this period, as well as L&T Finance, not an NBFC that we talk about daily, but still up 63% during this period. Among the underperformers, of course, Colgate, IndusInd Bank now out of the Nifty, down over 40% each. Tata Tech, another Tata Group underperformer, down 40%. RVNL, the high flyers of 2023, down 40% as well. And Ireda, another PSU name among the list of underperformers. You look at the small cap names, Laurus Labs, after some quarters of struggle, is up almost 110% in the last 14 months. MCX at new peaks as well. Sagility, a recent listing. Naveen Fluorine, Narayana Health, all seeing gains between 60 to 70%. But look at the underperformers. Ola, that shows the pain in the broader markets over the last last year or so. That Ola Electric, Tejas Networks, Jindal Saw, Brainbee is a recent listing, and 50 to 60% of losses. Whirlpool too. Now add more, another 11% too. There's 46% drop as well. So there has been pain in the broader markets. There have been stock-specific winners as well. But the point being today that the Nifty is at a record high.
You know, it's such a different feeling, Hormuz. Thanks so much. That's great data. And, you know, those stocks really illustrate the point why this all-time high is probably one of the most thanda all-time highs we've had in my recent memory, right? And that's exactly what it is. It's not been one momentum-driven market where everything is up and about and there's, you know, there's a raging bravado. It's been almost an all-time high of disbelief. And even now the screen is a little thanda. But having said that, I think in the next couple of days we'll have the answer. And some of the technical experts were pointing this out. If the momentum now starts building up, if this level sustains, and if we cross the next 100, 200 points, and something starts building, then maybe we'll be looking at a very different market. But yeah, I mean, as of now, it's been just quiet, thanda. It's almost like a relief. Chalo, finally, ho gaya.
The foreign guys need to come back and sustainably so, because everything else is there, right? But there's one missing element. Hopefully that changes.
Absolutely. And there's been a lot of sector churn. I mean, the winners are very different. There's been a lot of pain in the stocks that have fallen by the wayside in the last 1 year. So very different all-time high. Anyhow, one sector on which people have been increasingly optimistic, and you just heard Tahir Bajra also make that point, is real estate. So let's get that conversation going. Mr. Irfan Razak, CMD of the Prestige Group, is with us. Mr. Razak, thanks so much for joining in. You know, from a market perspective, and we were just discussing this with the guest who was on earlier. While all of you, most of the listed companies have been sounding optimistic, the numbers have been good, the pre-sales have been good, real estate stocks have been a little quiet and somber. But we're not discussing the stock with you, we're discussing the business performance. super solid first half. The question is, can this sustain? Can this last? This 8-9% increase in pricing that you've reported, the kind of pre-sales momentum you've reported, is the going continue to be as good as you look at the rest of the year?
I believe, good morning. I believe that the momentum definitely can sustain. It's all about how you strategize and how you work yourself up and bring in the pipeline. And since the going is good, since there is demand, the teams also have been working very well and very hard to see that there is more and more inventory that we create and bring to the market so that the pre-sales can also be managed and the momentum is kept up. Yes, we have reached at certain highs. Now, from these highs, the only thing is that we have to sustain this. We have to make sure that the same momentum goes on. The demand will be there, but the most difficult part is bringing the inventory to the market. What it means by bringing the inventory to the market, land is the raw material, then it's the approvals and all of that. So it's a bit a tough job. But I think the teams have pulled this off in the last 2 quarters. And I think the next 2 quarters also should be pretty strong.
So, I mean, and real estate obviously is a lumpy business. So you'll have some phenomenal quarters and then 1 or 2 quarters, there can be a lull. But if I average it out, I mean, you've been growing at 50%, at least in the last quarter. For this year as a whole, and more importantly, next year, because, your launch pipeline has been huge, 18 million square feet, right? So give us some sense on a sustainable CAGR basis, what's the kind of sales growth you're hoping to clock, not just this year, but going into next year as well? I mean, is 25-30% growth in sales momentum, is that a fair assumption?
I mean, it depends on what base you're starting at. See, now the base that has come up is quite huge. Nobody ever thought that a listed real estate or unlisted real estate company could do more than 10,000 crores in a particular year. Now that got surpassed. Then we talked about 15,000, that got surpassed. Then 20,000 got surpassed. So now we are all thinking that probably we can reach the 30K mark. But then at that level, at that base, for you to grow again 25% will be quite a challenge. But I think it would be fair to assume that we have to keep growth. And a fair growth between 10 to 12% on a very high base should be very reasonable to expect. And I think that's what we, along with the team, should work together to see that that is sustained. And because the market is there is demand, there is a need.
And that you're saying, sir, at the pre-sales level,
yes,
10 to 12% steady state pre-sales growth year after year in the near visible future, right?
Absolutely.
Okay. And this is from here on, because pricing has also gone up in most markets. And we were having this conversation with Pavitra Shankar just yesterday. So pricing is also important to understand, right? And pricing has gone up very smartly. Even for you, I think realizations are up 8-9%. So from here on, this pre-sales growth, will it largely be a function of volume? Or is there some scope to enhance pricing as well, across blended pricing across the portfolio?
No, I think it'll be more of volume. And I personally do not want the pricing to run up much more than what it has. Yes, pricing correcting itself and adjusting itself against inflation that's what is expected. But unreasonable pricing, because land price has gone up, expectations from landowners are more and more. That can't happen, and that should not happen. It's going to be counterproductive because we have to have an eye on the affordability also. We have to make sure the goods that we are producing are also acceptable at the consumer level, and the consumer is as yet able to still buy the product. It should not just go beyond their reach. So if we do a blend of both, yes, there is that niche market, which is the luxury market. That's a separate, I would say, a world altogether. But where the volumes will come from and where the business is the mid-income market. And that's where we need to have our eye on and keep working towards it.
Okay, all right. Hi, Mr. Razak. Just one quick question, sir. Good to hear that your business is doing well, and I'm seeing your projects coming up in Mumbai as well, which is good. The problem is this air quality is getting bad, and various quarters of the government are saying that they're looking into it, and they'll be sounding off various developers. Anything you have heard on that front, and any measures that you're taking, because the air quality out here is really taking a bit of a hit. So your comment on that.
I think in whatever work that we do have to keep an eye on the environment, including the air quality. It's just not the developers who are responsible for the bad air quality. It's a combination of many things that happen. But I don't want to shrug that off. We as responsible developers would definitely like to take steps and measures that will not allow dust pollution to go out of our sites. There are many things that we can do, including, we have to have that proper shielding of all the dust that goes out of the property.
Okay.
We have to do, trucks have to be wheel washed when they go out. So all this will help. Even small measures do help. And at the end of the day, that is what is going to protect the environment and protect the air quality. And collectively, if it's done, it'll have an impact.
Sir, quick last question. That's air quality, and we're really dealing with it. I mean, just never imagined that a city that's next to the sea will have issues similar to the national capital, which is landlocked. But that's the unfortunate part we're in. Quick last word on the labor code, sir, and whether that impacts the real estate industry in any way. Do you see costs going up? Because now it's all getting formalized. A lot of the additional benefits would perhaps be coming through.
I think labor is off late in the last few years has been a concern. Unfortunately, there's migrant labor that comes in from the eastern part of the country. It's who comes and settles down here and works really hard and to churn the wheels of the economy. And they need to be protected. They need to be paid their wages correctly. And I do believe that labor has to be, one thing is skilling needs a lot more focus on. And we need to bring more and more quality of life for the labor so that they come and take these trades and they keep producing. Because
what is the cost increase, sir, if at all? I'm not sure, because there are 4 different codes and one of them deals with working conditions, health and safety, etc. So have your teams right now worked out if there is a cost implication, any increase?
There will be a cost implication, but I think it is for the good. And they will be, because see, I believe labor is the last person in the line, and their lives also need to have a quality of life. And we should be the first to see that we protect that. And I think the cost increase on labor, just that component of labor, should be anywhere between 10 to 15%.
Okay, so labor costs could go up by 10 to 15%. That gives us a sort of ballpark working estimate. And of course, like you're saying, it's for the good. So it simply has to be sort of taken up. Thank you very much, Mr. Razak, for joining in. Good to get all of that perspective from you. You have a good day as we go forward. We'll take a break. And are we still retaining the all-time highs? No, we're not. We've actually slipped 26,243. After the break, we get you a special discussion on India's big push on rare earths. Rare earths, they're mining, taking it all the way to creating those magnets so we do not face a crisis like the one that the industry was in just a couple of months back. Back with that discussion in just a bit. Welcome back. Okay, that's a really important story that's breaking on your screens. It seems Tata Power's Mundra UMPP, the ultra mega power project, could resume operations by, well, December. And Vivek is picking up more details. Vivek, this has been stranded for so long, those power purchase agreements that just don't get signed, and the whole tariff issue. What's the latest?
Well, that's right. So it's an important development as far as Tata Power is concerned. What we are picking up from our sources is that Tata Power's, almost 4,800 megawatt ultra mega power plant, which currently is stranded. It doesn't have any long-term PPAs with any of the 5 state governments, and also it is not currently operating under Section 11, that is the Emergency Act, where power was being procured on a cost-plus basis. But what we are picking up is that now the plant is in a state of readiness, and as the management had alluded in its Q2 conference call, the company as well as the Gujarat state government have reached an in-principle agreement to go ahead and sign a supplementary PPA for this particular plant. Now, this actually will end almost over a decade of an overhang as far as Tata Power's Mundra facility is concerned. And this PPA, we understand, will be reflective of the current cost of the coal that is being imported. Now, also, the important thing is that in the conference call, as well as what we understand from our sources, is that all of the 4 other states, will actually use the Gujarat model as a precedent to go ahead and sign PPAs in case this does fructify. It's an important development. We reached out to the management and we've been constantly, getting their feedback as well. At this point of time, they're not responding. But an important, point to note is that in the Q2 conference call, in a pointed question that both we asked in the media call as well as the analyst call, the management said that while they could not run Mundra under Section 11, they are in discussions with the government of Gujarat to finalize and they expect that the conversations which are in the last stage should be done by the end of December itself, or they are hoping to close it by December. Just to note, in 2007, Mundra signed PPAs with 5 state governments, which is Gujarat, Maharashtra, Punjab, Haryana, as well as Rajasthan. Now, just to give some perspective as to how important this particular development is for Tata Power, when the plant was operating under Section 11, Q4 FY25, now the company reports this particular segment as a cluster of Mundra, coal, as well as shipping. So it includes also the Indonesian coal mines. It reported a profitability of 171 crore. And for FY25, on a base of almost 4,500 crore of PAT, this particular segment contributed over 1,000 crore. So it's an important part of the total financials. Now, in the 2 quarters where the company did not have the plant operation, Q2, the company actually reported a loss of 362 crore in this particular cluster. So any kind of relief, any development, or any positive action, especially from state governments when it comes to Mundra, is an important development for Tata Power, and we'll be tracking this particular development closely.
All right, thanks a lot for that, Vivek. Well, let's move on then to the next important discussion. We have the Union Cabinet that approved an incentive scheme to promote domestic manufacturing of rare earth magnets with an outlay of around 7,280 crore rupees. To help us out with what this means for the industry and the way ahead, we're joined by Mr. Mohanty, the Director of Finance, IREL, and Mr. Panda, the MD at IMFA. Good morning, gentlemen, and thanks a lot for joining in. Well, Mr. Mohanty, let me come across to you first. I believe that you all had plans to set up rare earth magnets plant in Visakhapatnam, if I remember correctly. What is the capacity, if you could tell us, and how do you look at the cost competitiveness post the scheme that has been announced by the centre?
Good morning to all. Actually, the point is rare earth permanent magnet are 2 types. One is from the samarium cobalt, and then another one is NDFE boron magnet. This samarium cobalt magnet IRL has already set off in Visakhapatnam. That is for the purpose of strategic use and not for the commercial use. The NDFE boron magnet, which is the scheme has come up with the initiative of the Government of India, which is a landmark step towards strengthening the domestic Caribbean manufacturing ecosystem. And this will definitely add technological self-reliance for the country. And this will bring the price disability currently around 43 to 44% is existing. This scheme will trying to mitigate that gap so that all the investors will come forward, and this ecosystem for manufacturing of magnets will be developed in India, which is missing since long.
Mr. Mohanty, I just have a question on how the scheme is going to function. And I'm just quoting what the release said yesterday after that cabinet meeting. So the total scheme outlay, 7,280 crores. It has two parts. There is a sales-linked incentive, which is 6,450. And this is for 5 years. And then there's a capital subsidy for 750 crores. So can you help us understand how these sales-linked incentives will work? What are the thresholds? What is your understanding of the scheme? And it's open to all players, private and public. So will you be working with private players, or will you be largely doing this, setting up some new capacities on your own?
Particularly, this scheme is the intention of the scheme is to invite private players to come and invest in this sector where there was a price disability. So for this, the government is looking for now particularly 5 different manufacturers to come where the maximum the subsidy will be given for 1200 ton of magnet making. And minimum is around 600 ton something they have kept. So once the 1200 ton magnet making will come per ton sales basis, this there will be one expression of interest, and based on that, each bidder has to quote what will be the maximum benefit they want, the maximum subsidy they want from the government of India. So on that basis, it will be worked out, which is envisaged to be 1,290 crore per annum. For 5 years, it will be around 6,450 crores.
So will you be, again, the second part of the question, sir, is whether you will be partnering with private players, or will you compete with private players in setting up these rare earth facilities?
It can be. Actually, the situation is wide open. The private players, if they have got the tie-up with different magnet technology providers, so private players can join with IRL, can do it, or IRL can take the technology from others and can set up, or IRL per se is responsible to supply this NdPr oxide, which is the neo rare earth elements, which is required for manufacturing of these magnets. So IRL will be, yeah.
So you can partner, you can do it alone as well. Just a couple of basic points. This subsidy, etc., is for actual magnets, not the mineral out of the ground. Magnets. It's not about how much you mine, but it is about the magnets themselves.
Yes, exactly.
Okay, which means that there is a processing capacity, etc., which needs to be set up for you to do this.
Yes.
I remember in our conversation earlier, just to go back to the basics, you said that we have lighter elements in India.
Right.
The total reserve is about 7 million. Heavier we don't have, and that's the issue.
That is the issue.
How does that work against how does this resolve that?
Actually, I'll tell about that. India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having, but we require dysprosium and terbium, which are required for the this coercivity, or to have this high remanence, which allows the retain high magnetization and the coercivity in the magnet. So if that is not there, then this manufacturing will be difficult. In Indian resource, it is not there. So it has to be imported. This is available. Out of China, it is also available, like Malaysia and Australia, it can be sourced. At the same time, India is also looking for this source from the carbonatite source, which is available in Gujarat as well as the Rajasthan Siwana ring, where ample quantity of this dysprosium and terbium is available. Around 5% of the rare earth oxide available there is available, but this is at the exploration stage. Quickly, it is in government of India is.
This is with GMDC.
Yes, GMDC is Ambadonga, and the other one is Bhatikara. Is again.
So you're saying some element which is required to enable the magnets to be made is available with GMDC, and another.
GMDC, the GMDC, this facility has not come up. Right now, this dysprosium and terbium has to be imported. And on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
Right.
So, sir, what's the, and this is really important. So, while the intent is fantastic, we want self-reliance in these permanent magnets because of their widespread industrial use and auto use. But the success seems to depend on GMDC finding reserves of the, the certain, or you get a technology partner from, say, Germany, as you're saying. So can you tell us from your perspective, Indian Rare Earth, are you looking to set up these facilities for the magnets? We're just trying to understand the competitive landscape. Will you then, are you assured of certain supplies from GMDC, or have you started a tech transfer conversation with the Germans, say?
It is not exactly German. German is there, one of them. Then Japanese, like Hitachi, which is Proterial now. The Proterial is there, and Sensex 2, which is the largest magnet manufacturers. They are also all available. So technology transfer and other things has to be examined. Once this scheme has come now, then a lot of private players as well as foreign investors are showing interest. Okay. And IREL per se is the provider of this NdPr oxide. Okay. So the NdPr oxide will be provided by India, IREL. And this GMDC particularly, right now they don't have dysprosium and terbium. So this has to be definitely imported right now. And we are also looking for those technology which doesn't require dysprosium and terbium. And if it will be required, very, very minuscule only. Okay. Only around 0.5% of terbium and 1 to 3% of dysprosium.
All right. So just keeping, those chemical compositions aside, just to understand simply, the scheme is for magnets, which is more downstream in nature. And the chain is rare earth mining to rare earth oxides to metals to magnets. Is that correct?
Yes, absolutely.
Got it. So let's bring in then a potential player. Mr. Panda has been waiting by patiently. Mr. Panda, you have excelled in your business, the only miner here of chrome ore in India and backward integrated with regard to ferrochrome. How big an opportunity it is for your company, and what is your comment with regard to this? The scheme has come out 7,000 crores. The center clearly is encouraging players to come in there. Exciting enough for you?
Well, it's certainly a very, very significant scheme, Nigel, because not only are rare earth magnets important in themselves, but look at the broader picture. This is, as you just mentioned, it covers the entire value chain from mining all the way through to magnets. Yes. Number one. But it is a scheme which has implications and impact on major initiatives like Atmanirbhar Bharat, because you cannot look at self-reliance in manufacturing or many of the sectors where, without having control over rare earth magnets. And equally, that has then an impact on your Viksit Bharat ambitions. And finally, if you look at net zero, because rare earth permanent magnets have have usage in defense, in EVs, in semiconductors, etc. So there are multiple sectors related to your net zero ambitions. So from that perspective, I think this is something very significant. And what you mentioned about IMFA in particular, we of course have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. Mm-hmm. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
All right, and well explained, Mr. Panda. So there's an opportunity out there. We'll have to wait by for the fine print, and then in fact you'll take a call. But will you have to look for technology partners as well? If you could give us some kind of a sense in terms of partners that you'll be looking at, particularly on the technology front.
So I think two aspects are important. I was reading up on the scheme a little bit, what is available in the public domain at the moment. So it's both the sourcing of the rare earth oxides, and that's where IREL is an option. But I believe one has to look at some imports also, at least in the initial stages, while we focus on more sort of exploration, etc., to look at other resources. But this is where I think the government will come into play, both from a point of view of sourcing of the raw material as well as technology. And again, as Mr. Mahanti was explaining in his detailed intervention, that IRL itself could be a source of technology, but I believe there are other technology providers out there. So one has to look at it and look at it from I think this is something clearly one has to look at, not just from a commercial perspective, but also from a national, interest perspective.
Yeah.
Which is to, the intent of this scheme is to bring about, greater reliability to the supply chain.
Yeah,
So I think
absolutely.
every decision that one takes, whether it is sourcing of the raw material or the technology supplier, etc., I think has to have a national interest element to it, which I can't say overrides commercial interest, but is as important, if not a little more.
Okay, no, absolutely, very well explained, Mr. Panda. Mr. Mohanty, so to you, for investors who are watching, I think you should list IREL. I think that'll be the.
Okay.
Is there a plan?
Are you thinking about it?
Actually, IRL is a strategic unit. So far we are exempted from getting listed. So the options are open.
Okay, so
But has that gone up to Deepam at all, Mr. Mohanty? Any discussions?
Nothing has happened so far. It is all we are evaluating.
okay, so it's not out of the question, but
Yes,
of course,
yes,
I
definitely,
hear you.
definitely.
Mr. I know this is an unfair question to ask you, Mr. Mohanty, but maybe let me put it to you since we have you and you've explained the entire value chain and so well. You know, from a GMDC from a GMDC perspective, you said, well, they don't have production of this now. In your opinion, with this push from the center, how far out is production when we see meaningful output from the mines that they have, Mr. Mohanty?
I think 3 years down the line, 3 to 4 years down the line, that will take.
Okay, 3 to 4 years down the line.
Right.
Okay.
Because actually it is on the exploration stage, and now from the exploration to the flow sheet and other things must have been developed by now. They have to invite the tenders, put out the plans, statutory clearances and other things are there. So that itself takes a little bit of time. Other than that, setting up the plant and getting the production 3 years down the line. And considering the scheme, whatever is there, and the kind of interest shown by private as well as the government sector, so it seems 3 years, 4 years down the line, 2030, India will be definitely self-reliant.
Got it, Mr. Mohanty. Thank you very much, Mr. Panda. Appreciate you joining us as well. Very useful and insightful discussion, and we wish you both the best of luck as the scheme tries to help in this, building out this ecosystem. Sensex has hit a new all-time high as well. So we've crossed 86,000 for the first time. Nifty, of course, 26,300. So records all along this morning on both the Nifty and the Sensex coming through. I mean, the small cap index, of course, now some distance away. The Nifty next, of course, is also close by. What we'll do is we'll take a quick commercial break here. We're going to come back. We'll just look at commodities and what's top of mind with Manisha. Stay tuned. Coming up.
Welcome back. Fantastic morning for equities, all-time highs. Let's see what's happening in commodities. Manisha, over to you.
Thank you for that. I'm making it a sweeter Thursday for you because I'm talking about sugar right now, where we have seen the prices gain up in the international markets. We've crossed above 15 cents a pound, and that is a one-month low, one-month highs coming in for the sugar prices. So when you look at the overall move that we've made in case of sugar, it has gained up by nearly 5% for the month of November. YTD, we still seem to be holding on to those gains of around 21%, as you can see on your screens. And this is going to be a second straight year of negative moves coming in for the sugar prices. Well, the reason for this is that almost all countries seem to be producing more sugar. So last year, we were dealing with a deficit of 2.9 million tons. But this year, the new season, that is, we have a surplus of around 1.6 million tons. This is what is coming in from the International Sugar Organization there. Having said that, we are looking at higher production, not just from India, but from Brazil, which is the largest producer of sugar, and then Thailand, which is the third largest producer of sugar. So between these three countries, we are looking at higher sugar production this time around. Having said that, India will also export 1.5 million tons in the global market in the new season. That would mean more sugar entering the international markets there. Interestingly, when you look at the new season there, almost all agencies which have come out with their numbers yet, whether it's about ISMA, NFCSF or CRISIL, are all talking about 35 million tons of sugar this time around, which is nearly 18% higher from what we had in the previous year. Reasons for higher sugar this time around is one, higher cane acreage. The second is about favorable weather. And we also are looking at higher yields this time around. The India sugar industry has a lot of concerns, though. So even as we are looking at higher sugar production this time around, the MSP revision for sugar has not happened since 2019. At that point in time, the sugar prices were set at around 31 rupees a kg. That is where it stands right now. While the cost of production has increased to 41 rupees a kg, that is because you have seen constant hikes in sense of FRP from 275 to 355, but it also has been about the state advised price, which is SAP, which has been increased. Add to that the bonuses as well. So the price that the mills are paying to the cane farmers is much on the higher side, but the sugar realizations not so much. The other thing really is about the ethanol prices, which also have to be revised. For a third straight year, we haven't seen a revision in that. And this season is started, markets are anticipating could happen in the next fortnight or so. The other thing is about the concerns that the sugarcane distilleries are working at less than 50% capacity. So when ethanol blending was started and the whole plan was put out, it was to ensure that the sugar goes into this. But if you look at the rotation, or rather the ratio right now, that stands at 30 to 70. So 30% is what we are seeing coming in from sugar, and 70% of ethanol right now is coming in from grain base. A bit of a heartburn when it comes to sugar industry there. If you look at the global prices, they have declined by 22% in this year. That doesn't augur well as well for the exporters right there. And then it also has been about volatile production trends, compensation from the, competition from the good and unorganized Khansari sectors as well, are some of the challenges that sugar as an industry seems to be facing on.
All right. Thanks very much for that. Manisha, appreciate you taking us through top of mind in terms of the commodities and soft commodities in focus. Lata is going to be speaking with a very special guest on the other side of this commercial break. Axis Bank MD and CEO Amitabh Chaudhary on their FY27 outlook. That's coming up in just a bit.
Welcome back. Axis Bank shares are trading at all-time highs. Of course, Sensex Nifty and the Nifty Bank are also trading at all-time highs. Axis Bank posted perhaps the fastest loan growth compared to the top three private banks at 11.7% in the second quarter. There was a very good margin management as well. While many brokerages, Jefferies, Nomura, HSBC, have all a buy rating on the stock due to the better valuation, analysts are worried about the repeated one-offs that have hit the P&L and, of course, more lately, some high-level resignations. To get an idea about the bank and how it sees the coming year, that is 2026, I have with me Amitabh Chaudhary, Managing Director and CEO of Axis Bank. Amitabh, good morning. Thank you very much indeed for your time. You're the first big banker we are speaking after the festive season. So how was it? How was the loan demand? And would you want to substantially increase your loan growth guidance?
So, Radha, thanks a lot for calling me on your show. Let me start answering your question. Loan growth during the festive period reflected strong customer sentiment and structural enablers. So just to give you a sense, on the Wheels business, we achieved a strong growth in October 25 versus 24 of 21%. And obviously, this was driven partly by the pent-up demand of September flowing into October and some of the GST rate cuts, which you saw, obviously the buoyant festive sentiment and positive customer confidence stemming from all the actions which the government is taking, and so is the regulator. And we saw some similar trends on the mortgage side. Even on the card spends, we got an extra boost with GST benefits coming in right at the start of the season. So we saw strong demand and double-digit growth across key categories such as durables, shopping, and online marketplace sales. For example, in card side, we had partnered with almost 200 brands during the festive season. So overall, the sentiment was positive. November, the trend is looking decently good. I wouldn't say obviously it will not be a repeat of the festive season, but overall, the market sentiment seems to be strong. You're also seeing clear upgrades coming through on the expected GDP growth rates. So I think that is also getting reflected in real projections on how the economy is expected to do. Obviously, I mean, there are always challenges, but overall, the sentiment does remain strong.
So you would want to give us a guidance?
Okay, sorry about that. Well, we are progressing well to be a stronger and sustainable franchise. We've been talking about that theme for quite some time. We do believe our platform will allow us to grow at rates faster this year than the industry. And this thesis, we believe, will continue to play in the medium term. The supportive regulatory conditions and the operative landscape obviously adds to our confidence. We have also said that in the medium term, which is defined as 3 to 5 years, we believe our advances growth will be above the industry growth rate. So yes, obviously, the credit growth rate is picking up. The numbers seem to indicate that. The deposit growth rate seems to be a bit tepid. But our view is that given the pipeline we have, given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry. And then obviously, in the medium term, we also expect to continue to drive our platform accordingly.
Okay, time permitting, I'll come back to this. The more recent news that hit the exchanges was the resignation of the chief risk officer. Now, actually, I went back for the past year. You've had not just Amit Talgeri, which is the most recent risk officer, Arjun Chaudhary, the affluent banking and cards guy, resigned. S. Bhaskar, the chief of audit, Ganesh Shankaran, wholesale banking. That was 1 year ago in November. So, I mean, is there a pattern we have to read, or were these all personal decisions?
Oh, well, there is no pattern here in the sense that, firstly, recognize Axis Bank as a great platform where we are generating talent which people want to hire. In some cases, the decisions have been personal. People have been doing the same job for a long period of time and they want to take a break. And so in some cases, some of the names that you took, people actually have picked up jobs post leaving us, which are more slightly less intensive in nature than what they were doing earlier. So it's not leaving the organization, it's making a lifestyle choice. In some cases, they've got opportunities which are very, very different from what they were doing in Axis. I mean, you took one name where the person has gone and is running a very small company, but the potential to grow it larger is huge. This is kind of a completely different platform. So I think the reasons are individual. I don't think it reflects anything on Axis, but I'm quite glad that people are now seeing Axis as a place where they can hire extremely good talent.
Oh, yes,
and
yes.
We have replaced Amit with someone internally. So we have enough talent internally also where people are getting opportunities to grow.
Okay. No, if that's the reason, that's very good. I just noticed the pattern. Let me come to the other news which CNBC-TV18 broke. My colleague Yash Jain, broke a story on the Insurance Amendment Act that's going to be tabled on Parliament. And there is a major liberalization in the sense insurance companies may be allowed to merge with non-insurance companies. Now, you have, of course, Axis Max and Max Financial. Do you think, therefore, a merger is imminent? If this is allowed.
It's been on the cards for a long period of time, Lata. I mean, we have been hoping that the new insurance bill will allow a merger of these entities. The core business will obviously remain insurance, and that's the only business they will do. Here we have a unique case where there is a holding company which holds shares in an insurance company, and so, that's the only thing they hold. And we would like to have a merger so that the shareholders of that holding company can take, ownership of the Axis Max Life Insurance directly. Recently, you would have also been aware, when the story was broken that IRDA has decided not to pursue the case in Supreme Court. So it's an indication from IRDA that maybe the bill is coming or they will allow something like this to happen. Our views are that there is further guidance expected from IRDA on this matter. And based on that guidance, we will act. Our intention and hope is that we will be allowed to merge the two entities so that there's only one entity which is out there. By the way, Axis Max Life is doing exceedingly well. And I think that is also reflected in the stock price and their market share gain. So we're very delighted with the investment we've made and how that entity is progressing.
Okay. You all had also expressed a desire to increase your stake in Max Life, that is Axis Bank's stake. But there was the SEBI investigation on the pricing. Anything latest from SEBI? And therefore, if that is a done deal, can you go ahead and raise your stake?
Well, the investigation from SEBI side is going on. Normally, these investigations and this process takes time. So we are going through the process. We believe that we have a very strong case here. That I think whatever we have done is with the full approval of the regulators involved. But obviously, SEBI as a regulator has the right to go deep into the case and take their view on whether what we did was correct or not. And we are going through that process. Okay. We would obviously like us to take our stake to 20%. We would also like to, understand once the forms of business circular comes as to what some of our options are. Right now, we don't know. Yeah. And at the right stage, we will see whether we want to increase our stake or not. We cannot take that decision unilaterally. There are other shareholders involved. So it will take time. Right now, there is nothing on the card.
Fair enough. Fair enough. Anyway, regulators seem to be in a more liberalizing mode. So let's see. Let me now come back to your P&L. Margins, it was a pleasant posting that you all did, just 7 basis lower NIMs. What is your sense about, will Q3 be the bottom? I think that's what you guided, that Q3 will be the worst. And there is a possibility of another rate cut. So then what happens to the NIMs?
So let me start by saying, assuming there is no further rate cut, let me give that position first. We expect margins to bottom out in Q3, mainly due to a slight, and the reason why margins might go down in Q3 is because of a slight tilt of loan mix towards wholesale over the last few quarters. Okay. And obviously, we'll see the agri seasonality impact in Q3. A bank has maintained that through life cycle, the cycle stance of average NIMs at 3.8%. And cycle is measured in terms of duration of 15 to 18 months, starting from the date of last rate cut in June 2025. So we are maintaining that stance. We do believe that the margin trajectory is like an inverted C. Effectively, margins will moderate when the rate cuts are announced, drop on the inverted C, and then it starts climbing back towards the end of the duration period, because then the kind of deposit rates also catch up. We all know that the expectations in the market on the rate cut are quite high. I think people are almost assuming that the rate cut is pretty much a given because inflation projections are low. And that obviously the impact of GST cuts is flowing through. So my view is that a rate cut might happen. So some of the commentary which we have given in the second quarter might change. But the overall, if you kind of expand the time period, overall our commentary on margins does not change. Quarter to quarter, it might be different because there is a additional rate cut that might come in.
Okay, fair enough. Now let me come to credit cost. Both credit cost and slippages as ratios fell, and that was positive. But you all have not gone back to your Q4 lows. Last year, Q4, your credit cost was 50 bips. Now you are 73. What should be the direction of slippages and credit cost? Can it go further lower?
We do not provide any guidance on the credit cost. But financial 27, we do believe would be normalized with effect in comparison to financial year 26. Okay. So we have had some one-off events. Firstly, they will get normalized. Secondly, credit cost cycle itself is witnessing a normalization from through cycle trough seen in financial 23 and 24. So despite this normalization process, so for 23, 24 were way lower than where they should be. Then we saw obviously a spike. Now we are kind of coming down to normalized levels, which will be slightly higher than financial year 23-24. But our view is that they will settle at levels lower than what we are seeing right now. And obviously, Axis Bank has been quite conservative in terms of the approach it has taken to the kind of the risks which you want to take in the business, both on the wholesale and the retail side. And our view is that this will continue. So overall, things are stabilizing, and they should stabilize at levels lower than where they're seeing.
Okay, I have just one more question on that, but let me, get out of the way a worry which analysts have. While you are a buy, the stock is a buy for many of the brokerages. There's just this worry. Twice in a row, you had a one-off. Yep. So, and then on October 9, there was another caution from RBI. So, should we expect another one-off, or is it over and done?
See, some of the one-offs which are there were subject and based on continuous evaluation of our policies, products, services. In some cases, we discovered them ourselves. In some cases, we were guided by RBI. Right now, we are not aware of anything which would result in a one-off. But, I cannot guarantee that this will not happen. Yes, we have taken that one-off, and the last one-off which we took, we have very clearly stated to the market that we expect this amount to be written off or written back completely in the March 28 quarter. It just gives us increased provisions in what we had earlier. We always had the COVID provisions which we have not touched. So we do believe we are a conservative institution. As and when we discover something where our standards or our accounting policies are slightly below what a typical conservative institution would have, we will step up very, very quickly and take whatever hits we have to take. We are not aware of anything right now, but the interpretations do change. Sometimes you do see things where maybe you could have done it in a slightly different way. That keeps happening, but hopefully the size of the balance sheet we have should be able to absorb them without too much of a problem.
Fair point. No, of course, it didn't impact margins, etc. Just now coming back to that slippages part, most of the banks, including yours, were lending a lot of loans to MSMEs. Now, do you see any danger at all? I mean, for other banks, they went even 29, 28% higher on MSME loans. In your case, I think it was 16% higher year on year. You don't see any danger over there, is there, MSMEs?
Well, as you rightly pointed out, there is an increasing commentary coming from NBFCs that MSME side of the business is seeing trends which are negative. And right now, let me just clarify once again, we have not seen any signs in our portfolios, although we continue to keep a close watch. The fact that it is happening somewhere in the industry and we are in the risk-taking business, we should obviously, be reading this commentary very, very seriously. Just to clarify why we might be different, significant portion of our MSME book is secured by way of immovable property or assets. So it adds comfort not only to the underwriting toolkit, but also recovery in case of stress. Just to give another data point, 85% of our portfolio and 87% of our incremental sourcing is from SMA 3 and above borrowers, which is obviously higher rated borrowers. So these rating scales are back tested and monitored with rigor periodically. And as on today, they demonstrate performance above acceptable levels on various parameters. Another data point, 70% of our loans are short tenured. Hence, reducing exposure to default is easier, or you can monitor them faster and lower than the long tenure loans. We also quite well diversified geographically and industry-wise. So there are things which tell us that, okay, we might be slightly better placed, but I do not want to kind of walk away from the fact that the industry is feeling some stress and we should be watching our portfolio like a hawk. And that's exactly what we are doing. By the way, the recent announcement from the government on the relief package, which is similar to the earlier ECLGS scheme, will also give some breathing room to some of the SMEs who might be suffering. So watchful, right now seeing no signs, but being extremely watchful about this portfolio.
Oh, thank you very much, Amitabh, for a many-sided interview. I could have gone on, but out of time, and the stock continues to trade at all-time highs. Thanks a lot.
Thank you. Thank you so much, Lata. Thank you.
Okay. Well, there you are. All indexes at all-time highs. Sensex, Nifty and Nifty Bank, and the stock we just spoke about, Axis. On that positive note, wrap up on Bazaar Chartbusters coming up.
You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangala Malu. With me as always, Nigel D'Souza. And today is a green letter day because the Nifty and the Sensex have both hit record highs. But as we celebrate the frontline indices doing extremely well, let's find out whether broader markets will do well or not. And that depends on the earnings environment, the demand environment, and how business pans out. And who better than some of the consumption companies to join us today? AWL is joining in today to discuss the business. Remember, AWL was earlier Adani Wilmar. Now it's AWL Agri. We have the CEO Anshu Malik and the Deputy Executive Chairman join us on the show as well. So Anshu Malik and Shrikant Kanhere, both of them with us. Thanks a lot, gentlemen, for joining in. For the first time, we're speaking as the Adanis, have exited the business entirely. So that really is the first question. How is life after that? Because were there any, management changes that the street can expect going forward with this development taking place? Now they're also declassified as promoters, not having stake in the company. Were there any agreements with business partners, vendors, etc., which was subject to the continuation of this arrangement, which stand to be renegotiated? If you could first, to start things, tell us, how life goes on without the Adanis. Anshu.
The life has not changed much in the sense that the strategy part, the overall outlook of the business and the confidence in the Indian market still remains very, very bullish and up. Now, on the management side, as you see, Shrikant is now the new MD and CEO of the company, and I move into as Executive Deputy Chairman. I have been in this company for over 25 years, so the continuing with the organization and guiding on strategy and other things which Shrikant and we will work together. Now, this is the only change that has happened in the light of change from Adani's exit. But otherwise, from company point of view, the business point of view, the growth strategy, investment strategy, everything remains robust, and we are going ahead with all the plans that we had.
All right, take that point. Shrikant, so in that case, welcome as the MD and CEO, your first interview. Important to know then what your strategy would be. How would it be any different or plus from what has happened earlier? If you could give us a sense.
I think as we go further, I think the top priorities for the company remain same what we were driving earlier. I think the food will remain the top priority for the company. We will want to grow the food to a sizable level. We are already a 1 million ton of food basket today. As we go further, we would certainly like this business to grow in a double digit as next couple of years, number one. Number two, of course, the distribution again remains on the top of our agenda because today with the 2 million outlet coverage, we are still reaching at close to 50% of the universe that we would cover. So distribution has to be there. And there's a lot of potential even now to grow. And as we go forward, I think all the growth which we see will be a distribution-led growth that we will see. And third, and of course, any CEO would like to drive, of course, the expectation from the investing community as well as the promoters is to consolidate the margins as we go forward. So these are the three top priorities that we would be driving as we go forward.
All right. Hi, gentlemen, and welcome, Shrikant. First of many interactions. As you said, food and FMCG, that has tremendous potential. And there are various touch points that you would like to go to. That said, as a percentage of the contribution, where is that headed? What's the timeline that you'll be looking at? And, if you could help us out in terms of the margin outlook. Once investments are complete, what should the broad range be?
Yeah, food, and I think we started our food journey sometime in 2015-16 with rice, and then we added wheat flour, then we got into a besan, nuggets, poha, and so there's quite a long tail now we have in our food basket with a varied margin structure. So as we speak today, our food is contributing close to 20% of the volume in overall scheme of the things, and it's quite a sizable volume rather, I would say, as I said, 1 million ton of food basket today. We would certainly want this to go beyond 25%, and that's something which we are working on, because the more food gets into the system, it to some extent also de-risk your oil risk or a commodity risk which we run on the oil side. number one. Number two, on a margin fronts, I think food certainly has got a better potential to have a margin as compared to the edible oil. Today, it's by design and to some extent an EBITDA neutral business because we are today in food in the investment and the growth stage. I think in the next couple of years, we would reach to a level where we will start consolidating margin as far as the food is concerned.
If you could give us a sense, Shrikant, how much a 25% volume contribution from food would turn into revenue contribution, because food and FMCG account for just 10% in your revenues right now. You said that you are looking to decommodify your business, but even in the categories that you're present in the food business, most of them are commodities, right? There is rice, there is soya nuggets, all these products that there are, pulses, etc. They're all commodities. So how do you decommodify that business? Are you looking to get into prepared dishes and things where the underlying price of that commodity does not matter as far as the user price is concerned?
So to answer your first question, what kind of level we are looking at in terms of the revenue? I think of our target, we have been saying this for quite some time. We want to reach to a 10,000 crore of revenue once we reach that 25% kind of volume. And I think that should happen in the next 2 to 3 years, number one. Number two, when I say decommoditization, I don't mean to that. What I'm trying to say is, since the food is less volatile as compared to the oil, so therefore more food gets added to the basket, you are de-risking the edible oil risk.
All right. And just a couple of questions before we wrap it up with Anshu. Shrikant, just tell me, you said you want to increase your distribution touch points. You're currently at around 9 lakh stores. What is your target over the next 2 to 3 years? And rural, it's about 31% of your revenues. What's your target here? Quickly.
Yeah, so on distribution front, we reached to close to 2 million outlets, direct plus indirect. Direct is close to 900,000 outlets. We would certainly like to cross this 1 million as a target by end of this year, number one. And on the rural side, of course, today we are reaching to close to 50,000 towns, and the rural contribution is close to 31. We want to make it to 35% by next couple of years. That's the target which we are running on the rural side.
All right. And Anshu, finally, on the larger part of your business, edible oils, if you could give us a sense on the remainder of this year, how's demand been? What's the kind of volume growth you're expecting? And given the sort of price changes, what's the inventory that you're sitting on? Should we see margin improvement from here on or margin reduction?
On edible oil front, we have seen at the India level, the domestic consumption has actually flattened and has not grown. Whether we look at Kantar reports or Nielsen, both are saying the same. We also see hardly 1% or 2% growth. Now, why is this happening? Possibly one, there in edible oil, if you see the price last year versus this year, you will find it's almost 25 to 30% higher. That has impacted the purchase at least at the rural or smaller towns. We have also seen the pressure in the metro cities. Going forward, the prices are likely to remain stable, and at these levels, consumers are getting back into normalcy. And we see this quarter, October, November, December, sales are picking up as compared to the first half of the year. Now, from a company point of view, we have started working on creating some premium brands and premium products, because we see there is a consumer which is looking at cold press oil, they are looking at first press oil, they are looking at organic products, and they are looking at expert solutions to their problem, whether it is sugar, high sugar problem, or there is cholesterol issues. So they are looking at it, and we have Fortune Expert oil, and we have 2-3 products on it where we find the sales are now improving, particularly in the e-commerce chains.
Take that point. Thank you, gentlemen, for joining in. Good luck for the growth prospects of the business going ahead. And as we pointed out, this is the first of many conversations that we'll have across your various businesses and discuss how growth is panning out in all of them. With that, we'll take a short break, come back on the other side. Somil Mehta of Mirae joins in for a quick technical check on the market.
back, markets holding on to good gains. We're at around the 26,300 mark for the first time ever. So scaling new heights, and the Nifty Bank is participating. 60,000 almost on the cards for the Nifty Bank. But the most heartening aspect today is yet again we have number of stocks advancing more than the number of stocks declining. Somal Mehta joins in to help us out with how would he trade the index. Hi Somal, good morning, good to see you. When trade on the index and 2 fresh calls on stocks as well. Go ahead.
Good morning to everyone. Congratulations to all of us for the new high. Calls for a celebration, right?
Yeah, but not feeling like that, Somal. The portfolio is not feeling so good. The mutual funds that we have anyway is not looking too much. But anyway, go ahead with your trades.
All right. So Nifty and Bank Nifty view definitely positive, as we've already spoken about it a few times. My targets on the upside now revises to 26,800, 26,900. That would be my target. 20 daily moving average still remains a very, very crucial point here, a crucial support here, which is 25,870 now, and 40 daily moving average is 25,700. So these are very crucial levels to watch out for in Nifty. My view is positive, and I'll be expecting 26,800, 900 as target on Nifty. Now on Bank Nifty, the targets revised to 60,400, 60,300, a little higher from these levels. And the support still remains around 58,650. So these are some levels, and view is positive in the short term, in the medium term, both. 2 stocks which I've chosen is both large caps. Bajaj Finance would be my first pick. It has started a new rally on the upside, taking support at the averages, taking support at upward sloping trend line. Great setup for a medium term trade and in the short term as well. Stop loss would be 1,000. Target would be 1,100. The second stock which I have is again large cap. HDFC Bank has started a new rally on the upside now today, has broken a flag pattern. Stop loss would be 980 and target would be 1,100.
All right, we take that point. Thank you so much for that. With that, we take a short break, come back, more news and updates on the other side. All right, you're watching us here on Chartbusters. As we look at it, 26,288 on the Nifty, the Sensex 86,000. Important levels, red letter day, green letter day, the way you call it. Celebrations, Nigel.
Well, that's right. We'll wrap up on Chartbusters. But talking about red, I believe the team of Trading Hour is dressed in more red than green. They are tuned on the other side of the short break.
And which of the three are dressed in red versus green? We'll have to find out. Take a break, come back, watch Trading Hour.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Patakia and Reema Tendulkar. Well, bulls are charging ahead. That's the theme, of course. The Nifty, decent gains from the lows as well. We are almost 100-point up on the Nifty as we speak. The Nifty bank contributing 0.5% higher as well. The Midcap index briefly saw some red, but it has recovered from those levels, up 20 points right now. The advance decline ratio is in favor of advances. But yesterday we saw a bigger rally. All the sectoral indices were in the green. The Nifty constituents did really well. For today, the contribution is not coming from across the board. We are seeing gains, but something like a PSU banking index, energy, realty, small caps, all of them are under pressure. So watch out for that one, and specifically the advanced decline ratio, because the market breadth is very important to track. That has been on and off in last couple of trading sessions. Hey guys.
Hi, we've punched through new highs and we're pretty much sustaining at those levels, at least in morning trade. And once again, global markets are fairly supportive. Nikkei, that's the Japanese market, has gained 1.25%. The Korean markets, which have been on a tear, it's been a record-breaking run for Kospi this year with a gain of about 66%. That's added on another 0.5%. So global markets are fairly upbeat. And Hormis, I always thought that maybe the markets would hit all-time high levels once that India-US trade deal is signed, right? Everyone was looking at that as the tactical trigger for us to cross this hump. But we've done it despite. So once again, underscoring that, or maybe taking note and acknowledging that earnings has picked up and domestic liquidity, of course, all thanks to retail money.
Hope is eternal, isn't it? And that is why ever since the conversations about this impending deal started to happen, positive connotations started to take place on this deal. The Nifty started to move higher from those levels of 24,587, which was the recent swing low. And then we started to move past that 25,000, went up to 26,000, then consolidated. And now we are at new peaks, 26,310. Now the new record high for the Nifty. And it's been that kind of a market where good news is getting factored in before it takes place. Of course, the trade deal yet to happen, but the anticipation of that trade deal has resulted in a lot of market moves, be it in those trade deal related names as well, be it the likes of the Gokaldas Exports and the Avanti Feeds and the kinds.
Oh yes, a lot of them, and export-oriented stocks, they were definitely on our radar. So we'll, of course, discuss them. For now, Gokaldas Exports, it is at the day's low, but a couple of other names which are on our radar because of the moves that we are seeing in the broader markets. Pull at something like a Gillette. That stock is up around 5% as we speak. These standalone refiners were under a lot of pressure yesterday, so there is some recovery from those lows. Chennai Petro is up 3% as we speak. A lot of discussions about labor laws, how that could impact a certain sector. SIS Limited, that is the stock on our radar, and that is something that we should be tracking as well. But Nifty at an all-time high, so many constituents to talk about as well. Hormuz has gone across to the big wall with what really led to that rally from the lows. Hormuz.
It's taken us 14 months to get back to where we were in September of 2024, and the Nifty now making new highs. But the bigger talking point is the fact that from the lows that we made in April, the index is up 19%. It's been a very sharp move on the upside over the last 8 odd months. And if you take a look at the contributors as well that have led to this move, you would not find the usual suspects. BEL, of course, has been one such name, but Eicher Motors is the top gainer on the Nifty from the 27th of September last year. Bajaj Finance a slight cool off from the record high levels, and therefore it has moved down to third place. But SBI and Bharti Airtel also making a move among the top gainers on the index over the last 14 months. But take a look at the underperformers. Trent, a high flying name until for a better part of last year, but has halved from those levels. Bajaj Auto incidentally made a record high on the 27th of September 2024 and is down 28% from those levels. Coal India, TCS, NTPC, all of them featuring among the laggards for the Nifty during this period. Now, if you take a look at the gainers from the lows that we made this year, BEL and Eicher Motors, of course, are the common names here. But look at M&M, the rally that it has had for ever since the GST reforms, Eternal, Geo Financial, all of them seeing gains in excess of 40%. But look at the laggards as well from this period. But the sectoral picture as well, the Nifty Bank has been a big contributor to this move. The index at record highs nearing 60,000, up almost 10 to 12% now. The Nifty Auto Index hasn't done much, but the IT Index has been an underperformer. The bigger underperformer, though, has been the FMCG Index. That's down 16% since September of last year. And the same quiet moves for the pharma and for the metal index as well. The Nifty may be at record highs, but the broader markets are the ones that are feeling the pain. The mid-cap index has done precious little during this period. The small-cap index is down 7%. And therefore, if you take a look at the stock-specific movers as well, you look at BSC, Paytm, Muthoot Finance, Indian Bank, all of them seeing gains of 60 to 100%. But take a look at the laggards. They are the ones that are the bigger talking points here in the broader markets. Colgate, IndusInd Bank no longer in the Nifty. Tata Tech, of course, Rima will talk more about that. But PSUs like RVN and IREDA, the high-flying names of 2023, down anywhere between 38 to 40%. The small-cap names also present a similar story. You have winners like Laurus, Navin Fluorine, MCX and Sagility, but look at the losers. Tejas Networks is down 60% over the last 14 months, as is Ola Electric, Jindal Saw, Brainbees, Whirlpool, all of them down anywhere between 45 to 50%. And these are just 5 names. The list will go longer if you take a look at the list of underperformers within the broader markets. But today's talking point, the Nifty at new highs, the bulls will definitely be hoping the broader markets play catch up pretty soon.
Thank you very much for all those numbers, and it's been a very uneven recovery. But what stood out is the fact that in the large cap space, TCS has underperformed. In the mid-cap space, you spoke about Tata Technology. So let me pick up on the performance of IT stocks versus their all-time high levels. Well, a couple of observations. One, there are two Tata mid-cap companies which are 50% of their all-time high levels. We're talking about Tata Elxsi, where the all-time high level was 10,760, and the other one is Tata Technology. But if you just, broaden it out a bit, the takeaway is that ER&D company, engineering, R&D and development companies, which includes a KPIT, LTTS, they are the rank underperformers. And the key reason is the growth rates for these companies have moderated. So from the COVID low till FY23, these companies had phenomenal growth rates. Just for an illustrative example, if you pull up a KPIT Tech or you pull up a Tata Elxsi, you would see very strong growth rates of 30, 35% coming through. And then suddenly growth rates came off from FY24, FY25, and FY26 is also going to be a very sluggish year for these companies. The third is that large cap IT companies are about 20 to 30% off from their all-time high levels. So Wipro and TCS about 30%, Infy, HCL Tech closer to 20%. The mid-cap companies where growth rates have been high, and the poster boys here are Persistent and Coforge. These are the ones closest to their all-time high levels, about 6% and they're the ones which despite the weakness that we've seen in the broader IT stocks, have delivered some phenomenal returns over the last 3 years. So that's the sum and substance of the IT stocks. But moving on now, there is some news on Tata Power. An over decade-long overhang is set to be lifted on India's largest ultra mega power project, and it's set to resume operations after months of inactivity and over a decade of uncertainty. Vivek joins in with the details.
Well, that's right. So, one of the most important plants, in fact, one of the largest plants in India, and especially for Tata Power, the Mundra UMPP, which is the ultra mega power plant, which is 800 into 5 megawatts, which is close to 4,000 megawatt, and this particular plant has actually been in operation since July 2025, when Section 11 was not extended. So now, it's been inactive since July, and not only that, there was absolutely no visibility as far as long-term PPA is concerned. But now what we are understanding from our sources is that the company as well as the Gujarat state government have reached an in-principle understanding to go ahead and sign a supplementary PPA to resume operations and to start procuring power from the Mundra facility. Not only that, remember the original PPA was signed with 5 states, and we understand that once the Gujarat supplementary PPA is signed, of all of the 4 other states will use that as a precedent and go ahead and start procuring power from Tata Power at what will essentially be very similar terms and conditions. Now, we reached out to the management of Tata Power. So far, they have not yet responded to our queries. But just to give a sense of how important this particular development is for Tata Power, in FY25, the company reports a cluster, Mundra Coal and Shipping, and this particular cluster reported a PAT of 1,078 crore. It's reasonable to assume that majority of the contribution would have come in from Mundra itself, and it was just operating under Section 11, not a supplementary PPA. In Q2, on back of the fact that Mundra was inoperational, that particular cluster actually reported a loss of close to 362 crore. So, the importance of Mundra cannot be underestimated. It's an important development, and we will keep updating our viewers on the same.
Okay, all right. And we'll keep coming back to you as and when there is an update, Vivek. Thank you so much for joining us with all those exclusive details. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll focus on the crypto market as always with Manisha Gupta on the other side.
Welcome back. As promised, let's talk cryptos. Manisha is now joining in as always. Manisha.
Well, thank you so much for that. What I'm talking about today is Metaverse, because we've seen this economy continue to evolve and grow as well in sense of numbers there. Well, there is increasing demand for immersive experiences, and that is where it's taking the markets from. When we talk about evolved Metaverse, well, the fact being that earlier it was all-encompassing, single, massive virtual world where you could go party, meet and buy land as well. Well, that's not what's working right now. What is working is smaller, focused virtual experiences, which perhaps companies and education centers and a lot of gaming companies as well seem to be bringing in now. So when you look at the overall market here, in 2023, Metaverse overall was $82 to $95 billion of a market, with an expectation and the kind of growth that we've seen in the last many years, expected to be a $1.3 trillion of a market by the time we are in 2032. Now, when you talk about Metaverse, it's built on a lot of converging several technologies there. To begin with, it's about virtual reality headsets, which, by the way, seem to be getting lighter and more precise. Augmented reality glasses is another thing. Artificial intelligence, because that helps in generating content and power automated entities within those virtual worlds itself. And most importantly, when you try to own something in these virtual worlds, it has to be on blockchain and Web3, because this is where decentralized finance tools and ownership of digital assets will happen. And then, of course, it is about high-speed connectivity, which is crucial for real-time, seamless interactions within the Metaverse as well. I also want to take you through on where major focus into Metaverse really seems to be coming in right now. One, well, absolutely, it has to be gaming, because that is where you have to have that AR, VR and immersive experiences there. It also has to do with work and education. A lot of websites, apps, projects now seem to be working towards in this direction, where immersive Metaverse is working in sense of education. Social interaction, well, yes, a lot of meetings seems to be happening in that sense there. And then there is commerce. A lot of jewelry companies, sales, commerce seems to be happening, buy and sell within Metaverse as well, where you can experience the product in sense of Metaverse. And then travel. Remember those 3D houses and travel locations, etc.? Well, Metaverse really seems to be using it to full hilt right now. And then there is, of course, cultural environment. This includes of concerts, meetups, etc., wherein as well, Metaverse as an economy seems to be going quite fast.
Okay, all right. Metaverse, so much focus, and we spoke about it some time back, and now again, as you're saying, it's back in fashion and we are talking more about it. Thank you, Manisha, for bringing us all those insights. With that, we'll slip into a break. When we come back, we'll discuss market technicals with Jay Thakkar of ICICI Securities. Welcome back. Well, there is some selling pressure from the top. The Nifty is up 73 points, yes, but there's some selling which has come by as well. Bajaj Auto, Tech Mahindra, Infosys, TCS. So some of these IT names, they are leading to the pressure on the Nifty from the highs as well. Bajaj Auto is at the day's low. We do have some selling pressure on Infosys. The stocks like Reliance Industries, a big weight on the index, that one too is putting some pressure on Nifty as we speak. The mid-caps too have turned into the red. That's a 75-point downtick on the mid-caps, though the advanced decline ratio so far are in favor of the advances as we speak. The Nifty mid-cap index at the day's low. So watch out for that one because these lines are fast converging and market breadth will be important to track. But let's get in Jay Thakkar from ICICI Securities for a quick technical check on the markets. Jay, what are the charts suggesting? Do you think we'll see some profit booking today after the stellar rally yesterday and record highs today?
Hi, good morning to you, Sonal, and congratulations first of all to you and all the viewers of CNBC TV18 of again watching Nifty at the all-time high. I mean, it's definitely time to celebrate. But at the same time, we have seen the market breadth overall so far has been negative. But eventually, I think that with this kind of a breakout in the leading indices like Nifty and Bank Nifty, I think overall breadth is likely to improve going forward. So from the Sensex weekly expiry point of view today, that being the case, you can definitely see some volatility, some profit booking from the high levels due to the weekly expiry of Sensex. But overall setup, if we see, then I think now that until 26,100 levels on the Nifty aren't broken, until we don't see a close below those levels, at least for this weekly expiry for Nifty, or maybe until 9th of December, that is the next weekly expiry. For next 2 weeks, I think Nifty is definitely in the clear uptrend, and we have a target of 26,500 now going forward. And eventually the target comes to 26,800 for the December series. Then the logic for that, Sonal, would be that we have seen a good rollover happening overall market-wide. But there has been a good short unwinding by the FIs, and the index shorts have come down almost to 90,000 contracts now by the FIs. And generally, whenever we have seen this kind of short covering happening, generally Nifty has gone up by 1,000 to 1,500 points. Now, if we take that from say 25,800, which was the previous base, then I think 26,800 should be the conservative case for Nifty. So for the December series, those are our targets, and for next 2 weeks, I think 26,500. Those would be our target for the index. So we continue to maintain a stance bullish for the index.
Okay, gunning for 26,500. Jay, out of time, but thank you very much. So, still bullish going into the year end. But Thomas, you're looking at Whirlpool, large block deal?
Oh, indeed. And it has been in conversation for the last couple of years now for Whirlpool. And today we saw almost 1.5 crore shares that were traded today. 11% stake. So the initial plan was to sell 7.5, but then the deal was upsized and we almost 11.5% equity that was traded. The average selling price today was around 1,041. And the street had a whiff of this, that this is in the works, because Whirlpool Corporation, the parent company, during its third quarter earnings presentation, they mentioned that they are going to announce this stake sale sometime towards the end of the year. And the fact that they are going to bring the stake down to 20% in the first half of 2026. Now, the price at which the previous block took place was at around 1280, and the stock has since then been on a bit of a downtrend, and today's selling price was of course around 1041, and yesterday's close was around 1200. So which is why you see that bigger fall that you're seeing on the stock price, because it was a substantial discount at which it took place. Now, in February of 2024, the promoters had sold 24%. They bought their stake down to 50. They had 75 earlier, and they made no bones about the fact that it was because of the valuation arbitrage is why they sold their stake. The Whirlpool Corp CEO, in an interview to CNBC, stated that very clearly. The parent company trading at cheaper valuations, the unit trading at much expensive valuations. At that time, Whirlpool India was trading at around 50 times. The parent was trading at around 7 times. So that was the big deal. And of course, a lot of the funds were buyers in that. SBI, IMF, Society Generale, Nippon, all of them. And since that deal in February of 2024 until October, the stock had almost doubled. It went up to levels of almost 2,500 by the end of October of 2024. And after which there was some concerns with regards to earnings, the overhang with regards to further stake sale, whether or not it might happen or not. And that is why the stock until the 29th of January 2025 was down around 36% from the October highs, which were around at 2450 levels. And on the 30th of January, Whirlpool made this announcement that the parent intends to bring that stake down down from 51 to 20%. Then they planned on doing that by mid to late 2025, but now they said that it will be in the first half of 2026. The 2 days after this announcement, the stock was down 30% within the next 2 days. And if you take a look at the shareholding as well, MFs were big buyers in that block that was sold in February. So they increased their stake. FPIs have increased their stake since from March 2024, from the very recent September of 2025. You take a look at that. But retail has chose to remain cautious. Their shareholding has remained relatively the same from around 5.5% to 6%. It is still the same at around 5.5% to 6%. The valuation arbitrage still persists. Although Whirlpool has seen a substantial correction, it is still trading at 38.2 times FY26 price to earnings. The parent is still trading at 11 times. So there is still a big gap in terms of the valuations. But there were recent developments that said that Whirlpool the parent company intends to remain in the business, and said that India will remain a key part because they have entered into this 30-year brand and license agreement. There are also exclusive rights for the Whirlpool brand, which can be extended by 10 years. There is a transitional service agreement. There is an intellectual property assignment deed. So there are a lot of developments that have taken place. And even Kotak, in their note, they said that these terms at which the deal has taken place are reasonable. And this will ensure that there is this long-term continuity of the business, even if the parent continues to sell stake. So now with this 11.5% stake sold, the promoter stake goes down to 40. But there is still this overhang because further supply is going to come over the next 6 months, that they plan on taking it down to 20%. So as of now, big underperformer. It'll be interesting to see who are the buyers in this transaction, but 11.5% lower on Whirlpool.
Oh yes, a big move there. Thank you so much for explaining that to us. But for now, we'll slip into a break. Up next, in an exclusive chat with Jonathan Garner from Morgan Stanley, we'll discuss market fundamentals, top sectoral bets, and a lot more. Stay tuned for that conversation.
Welcome back onto an exclusive conversation then. Jonathan Garner from Morgan Stanley, the Chief Asia and Emerging Market Equity Strategist, is joining in on the show. He has long argued that India stands out among emerging markets thanks to the strong earnings growth, a robust domestic investor base and an improving macroeconomic backdrop. And Jonathan, firstly, thank you so much for joining in, and what a fitting day to have you as well, because the Nifty and the Sensex both are at record highs today. Well, the first question, Jonathan, to you, you may be at record highs, but on a year-to-date basis, the Nifty is still up only 11%. Compare that to a lot of the other Asia-Pacific benchmarks, or even the global benchmarks for that matter. The index is still an underperformer. But would you think that with the changing macros, with the policy announcements that have been made, the foreign investors which have long stayed away from a market like India will finally start to make a headway back into Indian markets, especially because of the fact that we have been underperformers?
Yeah, so India outperformed 4 straight years, 21, 22, 23, 24. So you're right, there's been somewhat of a give back in performance relative this year, though obviously the absolute returns have been there to some extent. As that's happened, the valuation relative has fallen substantially from about 1 standard deviation above long run average versus other emerging markets to about 1 standard deviation below. And I think the reason that relative derating happened is that relative earnings growth momentum slowed. So we had a marked pickup, particularly in North Asia, in markets like Korea and Taiwan, which are very rich in terms of semiconductors, tech, hardware plays on AI, and to some extent, some limited extent in China. Nominal GDP growth slowed in India, slowed probably more than we thought at the beginning of this year. But as we look forward, our economists are resolute, and certainly, as you just mentioned, the market's starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. I think on the other part of your question, I think often when I've been on your shows, you've asked about the foreign investor, the FIIs. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year.
Jonathan, hi, morning. What's the overarching view on Asia and emerging markets? You know, as we were discussing, emerging markets have come off an exceptionally strong year, particularly, say, a Kospi. That's up 66%. But the gains are concentrated. It's led by AI, semis, all the technology plays. So first, if you could tell us the big view on emerging markets going into 2026, what do you like, what do you not like, and why? And secondly, if the AI frenzy were to cool, not a bubble, pricking or bursting, but just some moderation in the optimism, then how does it affect the dynamics?
Thank you. That was another 2-part question. So I'll try my best to remember both parts of the questions. So I think the first part of it about emerging markets overall, I mean, this year we had a tailwind from a weak dollar, particularly in the first half, and that eases financial conditions in emerging markets. We had a lot of multipolar world dynamics, as we call it, the whole trade and tariff debate. And that certainly around April, May caused almost all markets to fall. When we actually... Sorry, I can hear some feedback. When we actually go through the second half of the year, it's right, that dispersion in performance was very significant. But going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small. And most of our other market calls are relatively contained. And we're just arguing that to have a robust approach, investors need to focus on stock picking, and they need to be quite nimble. We're not done with macro volatility globally. We're living in very uncertain times. So it's not a sort of a bang the table opportunity on any individual larger market here for us. Thank you.
Jonathan, coming to India itself, before I get into macros and the sectors that you like, Maruti, that is one stock that is on your focus list, right? I wanted to understand what do you like about it right now? You called it a potential beneficiary of the GST reform and product pipeline strength. So what differentiates Maruti today versus 2 years back when we were talking about it suffering from the EV threat? What makes you so bullish on this one?
Yes, I mean, in terms of talking about individual stocks, I don't tend to do that on these because we have analysts that cover them. But what I would say is that it's in the right space in terms of GST, it's consumer discretionary. So when you get these cyclical upswings in activity, it's the kind of thing that tends to work well. And obviously, it's a stock that our analysts cover and that we know well.
What about sectors in general? You have highlighted more upside in, say, financials, industrials, and consumer discretionary. What is the strongest bottom-up signals that you're getting from these three sectors that make you bullish here?
Obviously, we work closely with Rhythm Desai and the team on all of this. And yeah, we're overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan, you mentioned we are living in uncertain times and the fact that the macro instability is not over yet. But India as a economy in general has had relatively stable macros, right? Because the first quarter GDP print was fairly robust, almost close to 8%. Polls for the second quarter GDP are also indicating a similar sort of print at around 7.5%. Do you see this economic stability as an outlier compared to a lot of the other global markets? Or will this uncertainty around this trade tariff deal with the US be a bit of a dampener going into the second half?
Yeah, so actually the drop-off in inflation in India is important. I mentioned in answer to your earlier question, nominal GDP growth, which matters much more for corporate top line than real GDP growth. And I think that's where the negative surprise came in. I think effectively the decline in inflation is telling us that policy was too tight. And likewise, credit growth actually falling to low single digits. This is not what one should be expecting from an economy that is still developing very rapidly. So what we're anticipating, hopefully, is that with the policy easing measures that we've had, the nominal GDP growth environment will accelerate, as I said, from kind of mid-high single digits to mid-low teens in the course of next year, and that will reignite the corporate earnings profile, which softened relative to those markets we talked about earlier that had a very strong year, the AI, tech, semi-capex kind of markets. They, by the way, are likely to continue to post strong earnings growth next year, maybe decelerating somewhat, but they will still be growing earnings next year.
Jonathan, would request you to hold that thought. Would love to continue this conversation on the other side, but just need a mandatory short break.
Welcome back. You're still tuned into Trading Hour. We still have with us Jonathan Garner of Morgan Stanley. Jonathan, we have been talking about how global markets have been faring, a lot of macros as well. You are seeing some upside for Japan as well. But, there's some nervousness around yen carry trade. We are talking about yen strengthening, yields are jumping. Do you think this is something which could impact markets globally and Asia as well?
In a word, not really. In a sense, what we're seeing is a normalization of yields in Japan from very low levels, consequent upon the BOJ intervening less in the government bond markets, which is a very healthy development, and the fact that reflation is ongoing. If you look at Japanese 10-year yields, they're about 1.8%. That's still less than a half 10-year yields in the US, for example. And if you look at the underlying situation vis-a-vis the yen, it's actually strengthened this week after we got the details of the fiscal package. And the fiscal package itself is entirely financeable. Japan is amongst the G7 almost unique in running essentially a balanced fiscal position relative to GDP. It's less than 1% of GDP fiscal deficit. So it's more than able to expand its fiscal impetus here. So the yen is undervalued. We think it will strengthen back towards the mid-140s over the next few months. And I think that process began in the last few days.
Jonathan, at Morgan Stanley, how do you all assess the risk of an AI bubble?
Well, I think that's far too broad a term to use. Certainly in recent trading, we're seeing more performance relative activity at the stock level. When we model out the impact on particularly what we specialize in, which is things like the upstream exposures in markets like Japan, Taiwan, and Korea, as I said earlier, we're anticipating continued strong earnings growth, particularly in the memory names, which are very dominant in the Korean market, for example, at least for the next 12 to 18 months. So, within the Asia coverage that we do have some recommended stock exposures in our focus list to it. And overall, yes, it's a sector that's trading on very high valuations to its own history, but it is also exhibiting by far the highest ROE of any sector in our coverage right now. These major companies in Asia are generating 30% ROEs. So obviously they're the equipment suppliers to the infrastructure build out that's going on in the sector globally, and they're doing very well.
Back to India, overweight position, but you are recommending a tight risk position. Can you elaborate a little bit more on that and what you expect in 2026?
Yes, to be precise, we're 75 basis points overweight. At our maximum bullish, as I say, back during those 4 straight years of outperformance, we were at times 200 basis points overweight. So we moderated our bullishness on India this year. But then we have relatively tight risk positions in all markets currently. Ridham Desai and the team just set a Sensex target of 95,000, but again, with a wide bull-bear range around that. And that would certainly be consistent with India outperforming because it gives more upside than we have for overall MSCI emerging markets, where we have something like a 1,400 target.
And what's the bull-bear on the Sensex?
76,000 up to 107,000. So quite a wide range. And that's a feature of markets globally, and we talked at length in our year ahead report about that. If you think just about this year, from early April to now, the EM index is up around 35%, and the Topics index is up over 40% since early April. So we're not, in a sense, in normal times for the kind of performance that we can get, the performance volatility we can get.
Jonathan, come December, you would expect that activity would cool down and people would go on holidays. But the 2 major policy actions that are lined up, at least for our own markets, one being, of course, the RBI policy, and then, of course, the Fed decision on the 10th. Firstly, considering what you spoke about for the Indian economy, you mentioned that earlier policy rates were a little too tight. Do you expect further easing from the Reserve Bank going into this policy and in 2026? What are you pricing in for that? And the same for the Fed as well. Do you see a rate cut on the 10th? And what policy actions are you pricing in for 2026?
So if you start with the RBI, yes, we do expect a 25 basis point rate cut. After that, we'll see on hold probably for a while. In the case of the Fed, it's very balanced. The probabilities are moving around almost by the day. But in the most recent note from my colleague Michael Gapin, he counts, I think, 5 Fed governors as in the no rate cut camp, 4 as in the cutting camp, and 3 as agnostic or undecided, including the chairman of the Federal Reserve. So it's very delicately balanced for the Federal Reserve.
Hey, Jonathan, a pleasure speaking with you. Thank you so much for joining us today with your insights and the outlook on markets, EMs, and a lot more. That was Jonathan Garner of Morgan Stanley. With that, we'll slip into a break. But as we do that, here's a quick programming note. If you're looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Sumaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. Ask your questions live on 28th of November at 1:30 p.m. Become a member today on the CNBC-TV18 app or log on to cnbc-tv18.com/access/plans.
Welcome back. Some tempering of the gains. The all-time high today was 26,310. The Nifty is at 26,240. So come off a bit. In the green though, but just by a smidge, up close to about 0.1%. Kotak Mahindra Bank continues to go strong, sees buying. But on the flip side, profit booking is visible in Bajaj Auto, so that slipped over 1%. Tech Mahindra has come in for some amount of pressure. L&T in the green, up 1%, but from the day's high, that too is seeing some tempering of the gains. Tata Steel, Jio Financial, Eternal, these are some stocks where you are seeing some tempering of the gains and moderation.
Okay, yes, so that's the market update for now. With that, we'll do one thing. We'll wrap on this edition of Trading Hour, but stay tuned. Halftime report is up next with all the market action.
Nifty scales to a new all-time high of over 26,300, while the Sensex powers past 86,000 as the S&P 500 index in the US resumes its AI rally. Morgan Stanley's emerging market strategist Jonathan Garner says India's valuation has turned attractive and he expects earnings growth to pick up next year.
In a likely resolution of a long-pending issue, Tata Power is likely to ink a supplementary power purchase agreement with the Gujarat government for its Mundra unit and restart its operations in December. This pact is likely to be used to ink power purchase agreements with other states as well.
Whirlpool of India sinks after its promoter sells nearly 11% equity after upsizing the offer from the initially indicated 7.5%. The sale results in the Indian arm ceasing to be a subsidiary as the parent stake slips to nearly 40%.
Axis Bank loan growth should continue to be better than the industry. MD and CEO Amitabh Chaudhary tells CNBC-TV18 that the bank is keen to merge Axis Max Insurance with Max Financial if rules change. He says he's watchful of MSME loans but doesn't see any cause for worry.
India winning the right to host the Commonwealth Games 2030 in Ahmedabad can spell nearly 15,000 crores in terms of development boom in the city area. Going by past records, infra, realty and hospitality players are likely to be the key beneficiaries. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Patra and with me is Mangalam Malu. Well, what a day it is. We're sparkling for the markets. We're off the day's high, but nonetheless, we have touched that new all-time high for all of the indices, in fact, and the Nifty Bank yesterday's trade itself. So today we do have the Nifty, which is just about come off those highs. So at around 26,250 odd is currently where the Nifty is at. The Midcap index is seeing profit booking at the top, so slipped into the red. But nonetheless, we do have the advanced decline ratio, which is on the positive side. So let's see whether that sustains. But we do have a couple of heavyweights which are at fresh 52-week highs in today's trading session. So that includes Reliance Industries, Axis Bank, Hero Moto, to name a few, which are at the top of the list in terms of fresh 52-week highs.
Take that point, Ekta. And in fact, we just ticked that mark of a record high for this year. And, it's good that it's come after 14 months, though the broader market has a lot of catching up to do when it comes to earnings growth, when it comes to revenue growth, when it comes to FII flows, and perhaps some certainty on international trade, and which is why this reflection of a record high is absent in the broader markets today in the advanced decline ratio as well, like you pointed out. Now we have almost an even Steven sort of red and green lines coming in out there. And eventually we will watch out for how the second half of trade also pans out, because we have the Sensex options expiry today that plays out. So we'll watch out for all those cues as we move along today's trading session. Kotak Mahindra Bank doing well, HUL fairly well bid, and a couple of these financials, Bajaj Finance, for instance, is at the top of the table when it comes to the gainers on the Nifty. But another stock which is doing well is Glenmark, surging on the back of receiving an establishment inspection report from the US FDA for its Monroe facility in the US. Ekta.
Well, definitely positive news which is coming for Glenmark. In fact, this particular Monroe facility has had a warning letter since June of 2023. So now they've received, it was inspected by the US FDA in June of 2025, where they were issued around 5 observations. And now they've received an establishment inspection report indicating a VAI, or a voluntary action indicated status, indicating that this particular facility is out of the woods and the company is going to start commercial production from Monroe again. The plant is expected to become more significant in terms of a contributor going forward post these regulatory issues now being ironed out. So that's definitely a positive for Glenmark. In terms of the other key point about about Monroe, Glenmark has made investments of around $100 million in the facility. So it'll be interesting to see what kind of contribution it has going forward in terms of the drugs which will be filed from this plant. But remember that Glenmark has been facing regulatory issues, for example, the import alert on the Baddi facility, warning letter to the Goa facility, as well as the Indore facility. So this definitely does come as a positive, and hope that the others would probably see some light of day.
All right, we will monitor the situation as we move forward. The US FTA and pharmaceutical sector having a very fun relationship. Let's move on. Let's talk about Trans-Rail Lighting then, the very first management on the show. Joining us now, Randeep Narang, who's the MD and CEO of the company. Obviously, the discussion will be around the new order win that the company has made in Middle East, North Africa rather. They've said that they're on track for 22 to 25% growth in FY26 on the top line. Let's see where that goes. And strong execution order and timeline. Will that momentum continue or not? Thanks a lot, Mr. Narang, for joining in. A good order win that you've got, around 550 crore rupees. But in light of your overall book of, nearly 9,500 crores as an order inflow for this year, it's not moving the needle much. It's just about 5.5% of your targeted order inflow. What I'm curious to know about is the first half of this year, you've done a 61% jump in your revenue and a near 50% jump in your EBITDA. You're still maintaining this 22 to 25% sort of growth target for the full year. Why is that? Do you expect some slowdown in the second half, or do you believe that you will outpace the guidance that you've given already, given where you are at the first half of this year?
So hi, thank you for having me here. So the actual revenue depends on the state and the quality of the project management focus. So some projects are into engineering approval stage, some are into execution stage. However, we had set a guidance of 23 to 25%, but we are confident that we'll cross 25% plus. And that's the change we're seeing now. Post monsoons, our execution is getting better and picking up faster. So we are confident that we will beat this guidance of 25%, definitely by a percentage point or two.
Okay. Well, Mr. Narang, if you could just give us a sense in terms of what kind of cumulative order inflow are you expecting in the second half of the year, and where exactly would it be from sector-wise?
Okay. So principally, we have around 15,000 odd crores of unexecuted order book and around 2,600 crores of L1. We have booked orders worth 3,700 crores this year so far, and a L1 of 2,000 odd crores, 2,600. So we're around 6,000 crores of fresh orders. We are looking at another 3,000 to 4,000 crores of new orders in the next 5 months. And we are on track for that. And our bidding pipeline is there. We're looking at bidding at least 30,000 crores of new orders in the next 4 to 5 months. So we're pretty much, our guidance stands stable and it is in line with what we promised.
All right. So you are on track for that 9,500 to 10,000 crore worth order inflows this year itself. What about the margins? You said it depends on the quality of the execution that you're doing, the quality of the client, etc. You have been guiding an 11.5 to 12% sort of margin range. First half of this year, you've managed to hold on to that 12% mark. Just the way you are going to outpace your guidance on revenue, will you do that on the margins as well?
I think 11.5 to 12% is the steady state we are looking at. Of course, there are some projects which are lower, some are higher. So we are looking at a balanced portfolio of margin management. We believe that 11.5 to 12 is a very stable margin profile, much better than our competitors. And we are therefore focusing to make sure that this happens. And we are pretty confident that we'll maintain it.
Okay. Well, Mr. Narang, you're confident in terms of your revenue as well as your margins. Just wanted to understand what you are doing when it comes to the international business, because you have 2 projects in Bangladesh, we do understand. Totally, I think it's around 30% of your total sales. Give us a sense in terms of the incremental order inflow, how much of it is coming from the international business, and are margins significantly different from, say, the domestic business?
So our current order book is around 60-40, 60 domestic and 40 international as we go along in terms of including the L1s. What we believe is that we will maintain that the India market is booming, the T&D industry is booming in India. And international also, there is a steady growth in Africa and other countries. So what we believe truly is that the margin profile has improved in India and international both. And therefore, we are in that good zone. You also know that we are well diversified backward. We are into towers, conductors, tower testing, making monopoles. So we have a very strong cost structure, execution skills, and diversified backward integration. So that helps us to maintain our margin profile.
Right. You're speaking about the margin profile itself. I just wanted your thoughts on two things in particular. One, in the second quarter, there was a big jump in your subcontracting expenses. If you could tell us what explains that and where is that likely to settle as a percentage of revenue. And the second part is the brownfield expansion, which is coming on track in the third quarter. How much will that support your operational performance, given that it will be more backward integration in nature than revenue recognition?
Yeah, so that's a good question. I'll answer the second question first. So the backward integration on our brownfield projects is on track and will be in stream by December, that is next month. Our new factory, which is for towers, a greenfield project, will be operational. It's already started slowly moving into the production planning, production startup phase, and by January that will also come into being. A conductor factory will happen by June, July of next year. So we're very much in line with our projections for supporting our revenue growth through our backward integration of factories of towers and conductors. Now, on your assets part, what you mentioned, we are particularly looking at higher execution happening. And as revenue is growing, there is also a certain amount of retention cost. There's a certain amount of inventory buildup, which is temporary, and which will ease off by March. So we already focused on that, and that will be closed and controlled by March.
Okay. All right, Mr. Narang, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Transrail Lighting. They have increased their guidance in terms of the revenue. They're expecting around 26 to 27% growth versus 22 to 25% that they anticipated earlier. And they are also expecting the margins to be stable at around 11.5%. We'll take a short break, but up next, we'll focus on the markets. Pankaj Tibriwala of Ikigai Asset Managers will join in to discuss the markets. Stay tuned.
Welcome back. The Nifty and the Sensex have hit a record high. The Nifty Bank as well, as has the Midcap index. But are your portfolios feeling that or not? Let's get in our market master today. We do have with us Pankaj Tibrewal of Ikigai, founder and CIO at Ikigai Asset Manager. Pankaj, always a pleasure speaking with you. It's one of those, ticking the box sort of record highs where, yes, the markets hit that, but, portfolios aren't feeling the same. The street is worried about earnings returning. The street is worried about growth returning. The street is worried about FIIs returning, and it's worried a little about the uncertainty around trade as well. Amidst all of this, where do you think one should actually invest to make their portfolios feel like they're at a record high?
Good afternoon. I think your observation is absolutely right. So let's look at the data. So if you look at Nifty, which is almost at record highs, but if you look at the median constituent of Nifty, it's down by about 8%. Similarly, if you look at the small cap index, it's about 8% away from its all-time high. But the median constituent of small cap index is on an average down by 21%. And if you look at the BSE 500, the median constituent is down by about 18%. So very few handful stocks have taken the index higher, but the breadth of the market has been extremely narrow and poor. And we have seen this in the previous cycles also, that sometimes the index is driven by few names and few stocks, but the breadth has been extremely poor. Now, what can change this? I think finally stocks are slave of earnings and flows. And when we look at earnings this quarter, I think it was a little better than expected. After many quarters, we saw an upgrade cycle rather than a downgrade cycle on an aggregate basis. And let's, Mangalam, decode the entire earnings space. So 500 companies reported earnings growth of 15%. And if I bifurcate into BFSI and non-BFSI, BFSI is about 92 companies, earnings growth of 7%. And non-BFSI, which is bulk of 408 companies, is about 21% earnings growth. Now look at the market cap earnings growth. The large caps delivered 9%, mid caps delivered 31%, and small caps after a long time delivered 35%. But a caveat there is that both in mid and small caps, a decent portion is driven by oil and gas companies. For example, in mid cap, it was HPCL. In small caps, it was Cochin Refinery, maybe MRPL and stuff like that, where we need to adjust for that. But even after adjusting, the earnings growth was quite healthy for mid and small cap space. So I think once there is more consistency for a couple of quarters, I think you could see the breadth also reviving back. But obviously, as you rightly said, market all-time highs, but portfolio of individual investors not showing that.
Okay. But Pankaj, if you had to just narrow down on maybe a couple of pockets that you like within the market at this point, within the mid-cap space especially, what would they be?
So one space where we have been positive is the auto ancillary space. I think the auto cycle after a long time seems to be reviving back. The ground feedback continues to be positive. Even after the festive season, the momentum on four-wheeler, two-wheeler, and even commercial vehicles have started to be quite positive. That's the feedback we are getting from the ground. And after a long time, auto ancillary seems to be in a sweet spot in the mid and small cap space, and especially the companies which are also pivoting themselves away from auto to non-auto. And there are many companies where the next 3-year outlook on non-auto, which is defense, aerospace, semiconductors, and maybe industrials, is shaping up to be very good because a lot of global suppliers are looking for manufacturing on precision engineering, and many of them fit the bill. So that's a space which we like. The second is the NBFC and the banking space. I think the NIM compression and the worst asset quality is behind us, and that's clearly being shown in large cap, mid cap banks right now. Earnings growth from here on should be quite strong for the banking space overall. And if you look at the lending, which is non-NBFC as well. But in non-NBFC, we have seen a sharp run-up already happen. So we need to be careful on valuations. But that's a space which can show you strong earnings growth. The third space where it's a contrarian call, I think, is metals and mining. I think you have seen a very strong quarter last quarter. But going forward also, I think that space globally is looking to be quite good. And you have seen a very sharp jump in copper, followed by zinc and other metals. I think that should reflect in the overall stock prices as you move ahead over the next few quarters.
All right,
So
auto ancillaries. Got that? Auto ancillaries, you like NBFCs, banks rather, and also the metal space, which is a contra call. So we'll, take these on board and wish that earnings do actually come back with a vengeance in the second half of this year, and then perhaps get you more on the consumption space and maybe a word on the IPO space as well, as more IPOs. Nearly 30,000 crore worth paper is likely to be supplied in December. With that, we'll take a short break, and as we do that, a quick programming note. Thank you, Pankaj, for joining in. If you're looking for big bets and market themes for 2026 as we move towards the start of the new year, CNBC-TV18 Access gives you direct access, as the name suggests, to White Oak Capital AMC's Ashish Somaya and Prashant Kemkar as they share their winning market themes and actionable investment strategies. You can ask your questions live on 28th of November, that's tomorrow, at 1:30 p.m. Become a member today on the CNBC TV18 app or log on to cnbctv18.com/access/plans. You're watching us here on Halftime Report on CNBC TV18 from the FNO desk. I'm just looking at a couple of trends at midday for the market. Yes, we hit a record high on the Nifty, the Sensex, and even the Nifty Bank in today's trading session. The Midcap index was yesterday, though we're off those highs right now. From today's high, we've given up around 70-80 points on the frontline index, which is usually par for the course. The only thing that we have to watch out for now is some profit taking, which is taking place in the broader end of the market, which is visible in one, the Midcap index not doing too well, currently lower by almost 90 points. And the advanced decline also comes up for you with a line which was far outnumbering the red one. The green line has now come closer. In fact, the red line has moved above the green line. So 1450 stocks which are declining for about 1400 stocks which are advancing. So the second half becomes extremely crucial. And the other thing is that the top contributors on the Nifty are just on the Nifty Bank. In fact, 3 of them belong to the Nifty Bank itself. So the market has to really broaden out, and Reliance has actually been the top dragger on the way down. Now, as we look at the market as it progresses, the important levels to watch out for, the 26,300 call writers are fairly active at 83 rupees, telling you that the market may face some sort of congestion or supply at around 26,350 to 26,400 thereabouts. But where equal vociferous writing is seen in the 26,300 put and the 26,200 put. So the 26,300 put comes up for you, premium of close to around 150 rupees, and the premium is actually down, which tells you that there has been a lot of writing which has taken place out there. So around 26,150, 26,200, there is support, and the 26,200 put as well for a premium of 100 rupees, telling you that there is support around 26,100. So 26,100 to 26,150 is the support, whereas on the way up, 26,350 to 26,400 is the supply. That's basically the sum and substance of the options data. Just a couple of factors we need to watch out for. The Nifty put call ratio from levels of 1.41 yesterday, which was at an overheated zone, came down to 1.38 earlier and now to 1.25. Around 1.2 is where the overheated zone ends. So we'll have to watch out for more moderation out there. And the second part is the Sensex weekly options expiry today as well. So could we see some impact of that on the Nifty in the last hour or not is something that we will be tracking. One stock I'm looking at, Samman Capital, was in FNO ban all of the last series. Does it get into ban again on day 1, day 2 of the December series or not is something we'll be tracking.
Okay, all right, Manglam. Thanks very much for that. So that's on the entire FNO space at this point in time. We'll take a short break, but up next, Manisha Gupta will be with us. She has with her a guest, Arun Raste, joining in to discuss the commodity space. Stay tuned.
Welcome back. Joining us on the show now is Arun Raste, he's MD and CEO at NCDEX. Mr. Raste, hi, thank you so much for joining in, and congratulations are in order because 770 crores is what you've raised as a preferential share issue, and you also are going on for the equity and derivative market there. What we do also understand is that it is the cash segment that you would be starting first on. Why do not you update our viewers with all of that?
Thank you, Manisha. Good noon. So, as you mentioned, we did raise about 770 odd crores from both domestic and international investors. We did a fresh round of equity, about 40 odd %. We will primarily use it for the equity and equity derivative segment. We did get SEBI approval a few months ago for starting our equity and equity derivative segment. So, in terms of the process, what we will do is we will start the equities first, and then we'll go for equities. But before that, there is one more addition, which probably you haven't heard about. We also intend to start a mutual fund platform, which will probably the first to go online, because that is not linked to the trading and surveillance system. So we can have a separate platform, and through which we can do the mutual fund distribution. So that will be our first offering. And that should be early in the next financial year, very early, possibly the beginning of the financial year itself, that we'll start it. And then later, as our systems and things in place, we will go for equity. And then after that, we'll go for equity derivatives. So in terms of if you're looking at calendar, probably next calendar year and latest by next financial year, all the three should be up and running.
Mr. Raste, the other thing that we also have been hearing about is you acquiring a 20% stake in the Sri Lanka commodity and financial derivative markets. What is that about?
No, so this is all subject to regulations, both in Sri Lanka and India. What we have agreed with the Colombo Stock Exchanges, if they get approval to set up equivalent of a NCDEX in Sri Lanka, we will be picking up stake in that. But that will be subject to regulatory authorities in Sri Lanka, SEBI approvals in India, as also DA or MEA as approvals required. Subject to approvals, we will be taking that. So what we have agreed with Colombo Stock Exchanges, they don't have derivatives at the moment in Sri Lanka, either financial nor commodity. So this new exchange, which might come up, will be dealing with both commodities as well as financial derivatives. And what we have agreed is we will be operating that for some time. We will be providing expertise, we will be providing them manpower in the initial stage, train their people, and also become stage. So put together for our efforts and whatever we are putting money, we are putting in, we'll get about 20 odd % in this new exchange. And that will be possibly subject to regulatory approvals. It should start sometime next year or a year after that.
Mr. Raste, just taking a step back, and as you mentioned that the first thing that will go live is your launch of mutual fund distribution platform. We do also understand is that it will function independently when it comes to the exchange's main trading and settlement system. So would you say the time that you're talking about, the timeline that you're talking about, is the timeline that you would require to set up operations and technology, etc.?
Exactly. So if you're setting up an exchange or if you're setting up a platform, there are three requirements. One is the technology part of it, one is the human beings, the people who will run it, and third is the market participants. So we are working on all the three fronts. We intend to hire something like say 100 to 150 people over the next 12 months to take care of all the three functions. As I speak, my team is at the moment speaking to somebody who's a technology provider for the mutual fund platform technology. And as far as the systems for the equity part is concerned, we have already floated the RFP, and hopefully we should close it by end of next month.
Mr. Raste, what are the plans looking like when it comes to equity and derivatives therein? Because you have BSE and NSE standing up as tall competition for you.
See, competition is the game, but I will just put some numbers in front of you. So I'll start with mutual funds. If you're looking at mutual funds, if you're looking at say 15 years ago, what was the number of people who were investing in mutual funds? It was just about 50 odd lakhs. Today it is 5 crore unique accounts. Right? So compounded growth or last 12 or 13 years, we have grown almost 20 times. And this growth will continue. So I was looking at some of the developed markets, maybe US or UK. 50% of the population is invested either through direct equities or mutual funds in those markets. If you look at that, compare that with India, it is just about 15%, 14 odd %. So the scope is humongous, 3 times bigger than where we are right now. If you look at equities, just last 5 years, if you look at data, year on year, every year you're adding about 2 crore people. Now, even with this, if you look at, mutual fund growth, see the biggest growth now coming into the mutual fund space is not from the top 30 cities. It is coming from cities. And that is the place where NCDEX has big roots. So thanks to our agri-commodity background, we are present in more places than the existing players. So definitely the population in rural areas which has not derived benefit of the growth in capital market, possibly we will give them the opportunity. Look at it from this perspective. I get a woman who is investing about 250 rupees in SIP every month, who is a customer of ours. We have about 12 lakh customers, farmers associated with us. Just 250 rupees a month if they start investing in SIP. My mutual fund portfolio will just fly from day one, right? So we will be looking at new markets, newer channels. Definitely there is space for 2 or 3 exchanges more in a country like India. Because if you look at a country like US, there are some 12 or 13 exchanges. China has 3 or 4 major exchanges. India has just 2. So there is enough space for more exchanges to come in. I don't see the big players will be affected by our entry because our target group is different and the pie is growing. This pie is growing exponentially. So there is space for everybody. We'll find our niche.
Oh, yes. Apart from BSE and NSE, now NCDEX as well coming in with equity and derivatives foray. And of course, the mutual fund platform could start in much, much earlier.
Okay. All right, Manisha. Thanks very much for taking us through that conversation. We need to take a short break. But up next, stay tuned for the conversation that we have lined up. SMS Pharma, that stock was up around 15% in yesterday's trading session. We'll be talking to the management on the other side. Stay tuned. Welcome back. Well, giving up a little bit of its gains for the Nifty. So 26,247 is currently where it's at. We're seeing profit booking coming into specific stocks such as Eicher Motors, which is at the low point of the day, down around 2.6%. Remember, it's been an outperformer this year, but seeing some amount of profits being taken off. But nonetheless, let's talk about one particular company, which really was one of the broader market gainers yesterday. SMS Pharma is the next management on the show. The reason the stock is in focus is because the FDA has approved a reformulated version of the acid reflux, very popular acid reflux drug, ranitidine, or popularly branded by some companies as Rantac as well, from its associate company VKT Pharma. So to talk more about this, we have with us Vamsi Krishna Potturi, who is the Executive Director of SMS Pharma, joining in. Vamsi, hi. Thank you very much for taking the time out. So you've received approval to manufacture the API of the reformulated ranitidine. Is that correct?
No, actually, we've received the approval to manufacture the finished dosage of the product, which is the tablets, and along with that, the API, which goes into the formulation. Yeah.
So you'll be manufacturing the API as well as the finished dosage.
That's right.
All right. Just give us a sense in terms of how exactly this drug is reformulated, just to, apprise our viewers. This particular drug was withdrawn from the US markets because of fears of it having a carcinogen NDMA present in it. So that's the reason why it was, it stopped being sold in the US markets, but now it's reintroduced. So just give us a sense in terms of what the difference is, and do you expect as much of a pickup in the US markets as there was earlier?
So coming back to so FDA has banned this product 5 years back, citing the reasons of NDMA for carcinogenic. But now we've liaised with the agency, we've complied with all their strict regulations, and now we've delivered the product that is very good in terms of controlling this NDMA throughout the shelf life of the product. And now the agency has given approval for us to relaunch the product. It's been a 6-year wait, and finally, after undergoing severe at different conditions, we've reformulated the product at different extreme conditions. We've tested the product, and when found okay, when we submitted all this data to the agency, I think finally we've received an approval.
So what does this mean?
Coming back to your point with respect to the market share, see, before the product was taken off, it was approximately around 400 million tablets was per annum was the market share on this product. I mean, it was a 5-year lag because there's no other ranitidine in the market, right from the innovator to no generic players in the market since last 5 years. So definitely this market share has moved on to other products, but yes, it will definitely come back, but we have to wait and watch. It's a slow growth, but we have to try and bring some market share back.
So from an SMS Pharma standpoint, that's the question, right? How much do you expect this to contribute to your revenues once you start supplying it, and what is the likely scale up going to be from here on?
Correct. So with respect, we will be starting slow, obviously, because it takes time to build the brand and time to get the trust of the customers back. Again, we would like to re-emphasize that the product that we've recreated, the reformulated ranitidine, is very safe, and it's much lower than the guidelines requested for the NDMA at various stress conditions as well. So this is a very strong product, and it'll take time for the customers to, get over this fact, but we know they'll come to terms with this.
Okay. What's the competition pipeline like for ranitidine in the US markets in the foreseeable future? I know you currently have the strongest market, you're the only player, but what's the pipeline like? Who are the other filers?
So right now, we are the only vertical integrated player on this product where we do the API and the formulation. So definitely, maybe it'll easily take our competitors at least 2 to 3 years, because they have to go through the same rigorous process that we went through of redeveloping this product. But yeah, if at all, if anyone enters, it'll probably be 2 or 3 players is my guess.
Okay, what I'm trying to understand, Vamsi, is basically whether you're expecting that kind of market to come back for ranitidine. Because if you see globally as well, because of the issues that had taken place 5 years ago, though the other countries had not, withdrawn the product, there was a shift to other acid reflux drugs simply because of the fear of NDMA in ranitidine. So do you think that has ranitidine in other markets actually declined over the years, and hence that gives you an assessment in terms of what it would be like in the US?
No, I think it's just about the fear of, having this carcinogenic impurity. So now a strong regulatory agency like the FDA endorsing this product, I think will definitely give a lot of relief to few other countries where this product, we will definitely see ranitidine picking up in the next few months, actually, as we speak. In various other countries. And again, as you rightly said, it's very difficult to get back that entire market that we lost, but it's a slow process. It's a slow process that, we can start and probably we'll get there someday, but it's definitely a slow process.
Let's talk beyond ranitidine as well. You have given us a growth target of 20% in FY26 with 20% margins as well. Halfway mark, you are pretty much on track to achieve that. Just a word on ibuprofen. You are planning to scale it up from what, 450 tons per month to about 1,000. How much would that mean in terms of incremental revenue for you, and by when?
So when we hit 1,000 tons per month, so that will probably contribute close to 600-650 crores of top line revenue for SMS.
And
just on ibuprofen, isn't it already quite a widely penetrated market?
Yes, it is a widely penetrated market. We are the latest entrants on this product, but we were able to get good market share across the world. And in US, we have almost 60% market share. In Europe, we have big customers lined up. So we are getting market share month by month. We are going incrementally month by month.
All right, we take that point. Thank you so much for joining in. And just missed this point on by when will it turn to 1,000 per month?
So it will probably from April. We will complete the project by April. So yes, from April on, it will be 1,000 tons per month.
Vamsi, always a pleasure speaking with you. With that, we'll take a short break, come back, get you more of the markets and a lot of stock-specific action. The markets actually picked pace once again. The Midcap index back in the green. Stay with us. Welcome back. There's been some recovery from the lows. The Midcap index just about moved into the green, now flitting between the flat line. A couple of these stocks belonging to the auto space in particular doing extremely well. Ashok Leyland was fairly well bid all of yesterday and now continues its up move up around 9% for this week with a 6% gain coming in right now itself, a big surge. And looking at Ashok Leyland, Escorts Kubota as well, which is in a similar segment, doing a catch-up. So that stock is up around 2.5%, closer to 3% as we speak. And Pankaj Tibriwala just spoke about some of these auto ancillaries doing well. So Samvardhana Motherson, for instance, has moved higher too. What we'll do is take your leave on this edition of Halftime Report on that note and take the market action forward with Business Lunch after this short break. Thank you so much for watching.
The Nifty scales a new record high of 26,310, while the Sensex powers past 86,000 as the S&P 500 in the index in the US resumes its AI rally. Morgan Stanley's emerging market strategist Jonathan Garner says India's valuations have turned attractive and he expects earnings growth to pick up next year. In a likely resolution of a long-pending issue, Tata Power is likely to ink a supplementary power purchase agreement with the Gujarat government for its Mundra unit and restart operations in December. This pact is likely to be used to ink power purchase agreements with other states as well. Shares of Whirlpool of India sink after its promoter sells nearly 11% equity after upsizing the offer from the initially indicated 7.5%. The sale results in the Indian arm ceasing to be a subsidiary as the parent stake slips to near 40%. Experts tell CNBC-TV18 that the government's incentive scheme for rare earth magnets is attracting high interest from foreign and domestic industry players. They, however, point out that this will entail importing some rare earths, even as efforts to explore local sources continue. And India winning the right to host the Commonwealth Games 2013, Ahmedabad can spell a near 15,000 crore rupee development boom in the city area. Going by past records, infra, realty and hospitality players are likely to be the key beneficiary. The long-awaited day for the Bulls finally arrived today. You're watching Business Lunch. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormus Fatakia. And after the Nifty and the Sensex both hitting record highs earlier in the day, there has been a slight cool-off, which is only par for the course after nearly 300-point up move yesterday, after an over 100-point up move in today's session as well. So some bit of profit booking coming in at higher levels. Of course, today being the Sensex monthly expiry as well, so that needs to be accounted for as well. So the bulls still ensuring that the Nifty remains in the green despite coming off the highs of the day. 26,310 is the record high. The Nifty Bank at one point had almost touched levels of 60,000, and that index too currently still around about that 59,800 mark. That is holding on to gains of around 300 points in today's session as well. So 59,870 the intraday high for the Nifty Bank, still trading around those record high levels is the banking index. But the pain though lies in the broader markets. The broader market breadth continued to struggle in yesterday's for the last few sessions, and today is no different. The mid-cap index has already moved into the red. The small cap index too is also off the highs of the day. So, and Nimesh also mentioned yesterday during his D-Street chatter that the participation in the broader markets was negligible, even though the indices were doing fairly well for themselves, and it was only a relief rally that was seen after oversold levels on those stocks. So the advanced decline currently at even Stevens as of now, but the declines have just about managed to overtake the advances. So that is the picture of the market currently, but it has taken 14 months for getting to those record high levels for the Nifty. Did happen in today's session, and you take a look at the bigger talking point. Of course, from the lows in April, the index is up 19%. That's the bigger talking point. When it comes to the contributors, of course, BEL, Eicher Motors, some of the top movers, Bajaj Finance, SBI, then gains of anywhere between 25 to around about 40 odd percent. Now, look at the underperformers. Trent, a street darling at one point of time, is halved. Bajaj Auto made a record high, or the same day that the Nifty made its record high, is down 30%. TCS is down 25%. NTPC is down 25%. So that is the picture among the losers on the index from September of last year. You take a look at the movers from April of this year from the lows, same names of BEL and Eicher Motors, but M&M, the post GST rally has been very substantial. Eternal has done well, Geo Financial has done well, but when it comes to the broader markets, that is the problem, and that has been the problem for the last few months. The mid-cap index from September of last year is up only 1%. The small cap index is down 7%. You take a look at the losers in the mid-cap index. Of course, there have been gainers, but take a look at the losers. IndusInd Bank no longer in the Nifty, still down 40%. Colgate down 40%. Now look at Tata Tech, a recent listing, a much hyped IPO, down 40%. RVNL and IREDA, the two high-flying PSUs for all through 2023 and a better part of 2024, down 40%. The small cap losers are painting an even worse picture. Tejas Networks, another Tata Group name, down 60%. Ola Electric down 60%. Whirlpool add another 11% to this 46% fall today. Brainbees is down 50%. Jindal Saw is down 55%. So this is only the top 5 names. The other list of losers will be even longer if you take a look at the smaller cap names. But today, the Nifty hitting record highs. The pain point, though, has continued to be the broader markets, and it has taken 14 months for the Nifty to hit to get back to levels to where it was in September of last year. And CNBC TV18 got the first global reaction from Jonathan Garner of Morgan Stanley. He told us exclusively that he remains overweight on India and doesn't believe that foreign investors are leaving the Indian markets. Listen.
Market starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year. Going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small, and most of our other market calls are relatively contained. Overweight financials, consumer discretionaries, industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan Garner of Morgan Stanley, the first global exclusive reaction to CNBC TV18 as the Sensex and the Nifty hit record highs in today's session. Now, an over decade-long overhang is set to be lifted for Tata Power as one of India's largest ultra-mega power projects is set to resume operations after months of inactivity and after over a decade of uncertainty as well. Vivek is here with more on this. Vivek.
Well, that's right. So what we are picking up from our sources are Tata Power's UMPP at Mundra, which is the ultra-mega power plant, having 5 units of 800 megawatt each, almost 4,000 megawatt of power capacity, which currently is idle given the fact that Section 11 has not been extended since July this year, and also uncertainty over the supplementary as well as the full-time PPAs that the company was looking at. But what we are understanding from our sources is that all decks have been cleared, and plant is all set to resume operations. And this time around, we understand that Tata Power has got an in-principle approval from the Gujarat state government for going ahead and signing a supplementary PPA. This, remember, is a material development as far as Tata Power is concerned. Now, when we are talking about the other states, remember, Tata Power Mundra has 5 other states, or a total of 5 states where they have signed a PPA with. We understand that 4 states will actually go ahead and use Mundra as a precedent to go ahead and sign a PPA with Tata Power. Now, we reached out to Tata Power for this particular development. They are yet to respond to our queries. But what we have to understand is that the importance of Mundra cannot be underestimated. Remember, a total of almost 1,100 crore of PAT from Mundra as well as Indonesia is something that it contributed to a total PAT of around 6,000 crore in FY25. And it actually reported a loss in Q2 on the back of the fact that Mundra operations were stalled. So it's a material development, under recovery, fixed cost under recovery will go away and will also contribute meaningfully to EBITDA.
Vivek, thank you for that update there. Now, in a big push to rare earth magnet manufacturing, the centre has announced a nearly 7,300 crore rupee outlay for rare earth magnet manufacturing. Now, this scheme aims to make India self-reliant and a key planner in global rare earths. The scheme also aims to strengthen India's automotive, defence and aerospace sectors. Currently, India imports all of its rare earth magnets. But Union Minister Ashwini Vaishnav said that India must become self-reliant in rare earth magnets in the next 4 to 5 years. Listen into what two big mining giants in India, IREL and IMFA, had to say about this opportunity.
India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having, but we require dysprosium and terbium, which are required for the this coercivity or to have this high resonance, which allows the retain high magnetization and the coercivity in the magnet. Right now, this dysprosium and terbium has to be imported. And on top of that, there are technology available like Proterial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
We, of course, have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain as it is at the moment, going through the details and looking at what is there on offer. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
Take a short break, but just before we do that, here's a quick programming note. If you are looking for the big bets and market themes for 2026, CNBC-TV18 Access gives you direct access to White Oak Capital AMC's Ashish Somaya and Prashant Khemka as they share their winning market themes and actionable investment strategies. Ask your questions live on the 28th of November at 1:30 p.m. Become a member today on the CNBC-TV18 app or log on to cnbctv18.com/access/plans. Welcome back. Now, the city of Ahmedabad has won the bid to host the Commonwealth Games in 2030. And Sonal is here to tell us this massive infra opportunity that lies ahead.
Well, yes, the announcement that Ahmedabad will host the 2030 Commonwealth Games could open up one of the biggest real estate and infrastructure opportunity cycles the city has ever seen. Large sporting events don't just bring athletes and spectators, right? They trigger a wave of construction, urban development, hotel expansion, and long-term demand for residential, retail, and commercial real estate as well. So let's break down where the biggest opportunities lie and which kinds of companies stand to benefit the most. But first up, let's just look at the costs that have been incurred in previous Commonwealth Games. The numbers are for you on the screen. Manchester, Melbourne, Glasgow, Gold Coast, Birmingham, somewhere between 10,000 to 15,000 crore rupees is the opportunity which is available. Now, sectoral impact. First, real estate developers. The biggest near-term opportunity sits with developers holding land around key games avenues, the athlete village and transport corridors connecting them to the airport and the city centre. Hosting the games means new world-class sports facilities, upgraded highways, metro links and also an expanded airport. All of this sharply improves connectivity and land value and adjoining micro markets. Developers with large integrated townships, mixed-use developments or upcoming residential projects in and around Ahmedabad and Gandhinagar could see accelerated demand as investors and home buyers they look to participate in the growth story. Some of the big real estate players in Ahmedabad include Adani Realty, Arvind Smart Spaces, Godrej Properties to name a few. There could be some opportunity in the airport link development as well because of improved international connectivity plus terminal expansions increase inbound travel, hotel demand, premium office or retail near airport as well. Of course, Adani airports will be in focus because of that. Construction and engineering contractors, they'll also be in focus due to venue construction, road, metro, airport works and hospitality projects. So the likes of L&T, HCC, GMR and any other regional large contractors and players will be in focus. These firms historically won major game contracts in Delhi and elsewhere as well. Hospitality industry, of course, will be in focus. There'll be surge in visitor nights for the games and longer-term business travel. It will lift revenue per room for these companies, per available room, that is. There is a new ITC hotel there as well. So stocks like ITC hotels, Indian hotels, etc. will be in focus on the back of this. But of course, the key to track now will be formal project announcements and tender awards from Gujarat or state government and the organizing committee as well. But this definitely could be a big boost to a lot of industries.
The big infrastructure boost lies ahead in Ahmedabad. Sonal, thank you for that update there. Moving on, a big launch from Mahindra's Born EV SUV platform. The company introduced the XEV 9S, a 7-seater SUV aimed at the mass market, which is priced at 19.95 lakh rupees. The car was unveiled at Mahindra's Scream Electric event, where it is celebrating 1 year of its Born EV platform. Let's now listen in to Rajesh Jejurikar, the ED and CEO of the auto and farm equipment sector, who spoke to Shireen Bhan at the M&M Town Hall about the company's EV plans.
We have believed, Shireen, that the EV portfolio has a lot of learning, and we have to calibrate the organization learning as you're building a category. And the last 6 months has been, and which is the reason why, even though we were ready with some of the other products, we decided to phase it out so that we build learning in the channel, the back end of the organization, quality, software, all of that. And I think we are at a stage where we're ready to ramp up, and hopefully Jan onwards we should see the numbers go up. And that's how we had planned it, which is why when we announced the first two, we had said the initial capacity we are operationalizing is about 4,000 to 5,000 a month.
Take a short break here on Business Lunch. More news and updates follow on the other side. Boy, the markets have taken a bit of a nosedive in the last few minutes now. 150 points off the highs of the day. The index, the Nifty is now down 50 points. Now well below the 26,200 mark and heading towards 26,100 now on the downside. The Sensex has also corrected 500 points. Both of them hit record highs earlier in the day, but the pain, as we mentioned earlier as well, is in the broader markets. The mid-cap index now is down 350 points from the highs of the day. The small cap index is now down 0.7%, already down 180 points from the day's high, and leading the move downwards are the banking names. The Nifty Bank has seen this sharp one-way move down from the intraday highs, and we had earlier started off the show when the index was near levels of 59,800, and now the index is down almost 300 points from those levels within a matter of minutes. And of course, we need to account for the fact that this is the Sensex monthly expiry that we are talking about. But the Nifty now below the mark of 26,150, almost 160 points off the highs of the day. And leading the index down are names like Reliance Industries, that's down 0.7%. Bharti Airtel is down 1%. That's the top contributor to the Nifty downside. TCS has taken a dive as well on the downside, now 1% lower on TCS. That stock too seeing a significant correction from the highs of the day. SBI among the PSU banks, the PSU bank index is the worst performing index so far in the trading session. Was down earlier in the day, continues to remain lower as well. The recovery in SBI has been sold into, as is the case in the PSU bank index as well, and is reflecting there. And Maruti is the other one that is leading the index down as well, 1.5% lower now on Maruti, move down in the last few minutes as well. But Whirlpool continues to remain at the lowest point of the day, 11% lower, as you can see at the bottom of your screens. But the picture right now, the Nifty down 60 points. It's a 160 point correction from the highs of the day after hitting record highs. Some profit booking setting in on the monthly expiry of the Sensex contracts. Take your leave on this edition of Business Lunch from me and the team. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Well, after touching record highs, there's a massive profit booking that's taking place. We are off around 160 points from the highs of the day on the Nifty. Midcaps in the red. Banks too have fallen. The PSU banking index putting some pressure. So a lot to talk about. But yes, we have seen all the rally being sold into, and that is key to track.
That's right. Good afternoon. And extreme volatility, especially as far as the markets are concerned. What we're actually seeing is the advance decline ratio breadth is something that has deteriorated quite rapidly as far as the second half is concerned. But we have a lot lined up on the show, so let's start off with the top headlines. Benchmark indices off morning highs after hitting fresh record levels. Energy, realty and PSU banks trade lower while financials surge. Midcaps relatively underperform.
Whirlpool is under pressure after a large block deal as over 11% equity worth over 1,600 crore rupees changes hands. Sources tell us that the promoter entity is the likely seller in the block today.
Car trade tech shares slip after around 5% in trade after the company announces that the proposed acquisition of its rival Cardeco will not materialize as both sides agree to mutually call off talks.
GMDC shares surge in trade. Another 8% rally today after 8% yesterday as the centre approves a 7,280 crore rupee incentive program for rare earth magnets, intensifying the country's push to build domestic capacity and reduce dependence on China. Okay, those are the top headlines. The mid-caps, the advance decline ratio when we started the trading day was in favor of advances. Now it has turned for the worse. And this is something that we were highlighting as well, that the market breadth, that has been under pressure for quite some time now. And those lines have converged. In fact, now there are more declines versus advances in trade. The small cap index too is lower in trade today. And across the board, there is some profit booking which is on the cards. But, a lot of other stocks which are on our radar. This is our special segment, Midcap Movers. We have Ria to take us to the midcaps that are moving around in trade. Ria.
Well, yes, starting off with the gainers first, we have GMDC up 8% today after the Union Cabinet approved a rupees 7,280 crore incentive program for rare earth magnets. The stock is also up roughly 22% in the last 3 sessions as well. Tejas Networks also up around 6% today. Even Ashok Leyland up around 6% today to hit a 52-week high today. This is also on the proposed merger of the finance arm of the company with NDL Ventures. Gillette also seeing gains of roughly 4%. And Dr. Agarwal's Health also up roughly 3 to 4% today and also up 8% in the last 5 sessions. On the losing side today, we have Whirlpool down more than 10% today after its promoter has sold nearly 11% stake in the company and they have upsized their initial offer from the initially indicated 7.5%. We also have Natco Pharma down nearly 5% today. Canes also down roughly around 4% today and down 17% in the last 1 month as well. Even Motilal Financial Services seeing a cut of roughly 4% today and down 12% in the last 1 month. And at the end, we also have GE Vernova down roughly 3% today.
Well, thank you so much, Ria, for joining in and giving us all of the stocks in the broader end of the markets that are making all the moves. But it's a good time to welcome independent research analyst Brijesh Bhatia for a quick technical check on the market. Good afternoon, Brijesh. Very tough, and we know it's a tricky question to ask you. But do you feel Nifty maybe has made a top-out pattern? Do you see further selling pressure, or do you feel we can make a recovery?
Hi, I don't think there is a topping pattern as of now because yes, the large caps have been few pocket has been roaring onto the market. We saw with IT, SBI, Reliance, L&T. I still believe 26,000 has been convincingly held. On expiry day, we saw 25,800 being strongly held. So till 25,800 is not taken out on the Nifty, I still believe there is a huge room towards 26,500, 26,600 levels onto the upside. Any dip towards 26,049 to 26,083 on the spot is a good level to look for a long opportunity.
Any individual names that you have on your radar, Brijesh?
On the mid-cap side, I think those stocks which are continuously outperforming in the current November series have seen a strong holding as of now also. Cummins India is the one which I think is a strong one we should look at. Two things are happening. First, though it was a long consolidation after a strong rally, bullish head and shoulder onto the hourly chart, indicating there is a strong momentum on the stock. Buy at around 44.20, 44.30. Target could be around 46.50 onto the upside and keeping a stop loss of 43.50 onto the downside. And my second pick will be M&M Financial Services. So if you look at the whole structure, we saw a strong rally between 2020 to 2023. Stock went into a strong rectangle structure. And importantly, if you look at the Fibonacci time cycle, it gave breakout right at around 127 week, which is a strong sign of a bullish trend. And now the trend assumption is that we have seen at 328 to 350, 360 level has been strongly held in current market as well, when markets see a profit booking. M&M is holding strong. So buy at around 358, 59, keep a stop loss of 345, and look at around 390, 395 onto the upside.
Well, thank you so much, Brijesh, for joining us, giving us a view on the markets as well as your individual trading calls. Well, we now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, the market breadth continues to deteriorate. After hitting lifetime highs, we've cooled off significantly. The Nifty now near the day's lowest point. What's actually dragging the market lower, especially in the last hour of the session? It's some of the large banking names, heavyweights as far as the bank Nifty are concerned. Have a look at SBI, that particular stock near the day's lowest point. Even a name like Axis Bank is dragging the bank Nifty and along with it the Nifty lower as well. And a sector that did very well in the session yesterday was the Nifty metal. But today, if you look at most of the constituents over there, a name like Welspun Corp, a name like JSPL, SAIL, all of these stocks under a bit of pressure as well. Another stock from the cement pack, that is Ultratech Cement, that particular stock too has now gone ahead, hit the day's lowest point. But like we promised, it's now time to speak to an important corporate guest. Rajesh Sharma, the MD of Capri Global, joins us now. Mr. Sharma, thank you so much for joining us. Q2 was quite strong for you. In fact, it was so good that you managed to go ahead and increase your AUM guidance for FY26, implying an 18% growth in the second quarter. Which segment are you currently seeing the growth coming from?
Yes, thank you. So growth is coming from all the segment, but more of the gold loan because you added more branches. If you see, last quarter we added about 86 branches, and gold has become almost about 40% of the overall AUM. Now, gold specific branches about 850. So with those branches, I think gold is growing, and further there is a cultural shift. Borrowing against from the gold is now getting more popularized and more acceptable, where in the semi-urban rural area, people don't hesitate to meet their short-term requirement from the gold. If you talk about MSME segment, that has also reasonably growing. Affordable housing, because of the push of the Pradhan Mantri Awas Yojana again, the demand we are seeing clearly, that segment is also growing. We grow almost 35% year on year in that segment also. So overall, it has been a very good quarter, and the joy has come from increasing our margins, and we have declared all-time profit after tax, which is about 236 crore.
Mr. Sharma, when you speak about how gold loans have now become 40% of your total AUM, do you expect it to remain at those levels? What kind of growth levels are you looking at here? And RBI has now eased the norms, right? So how much of the gold portfolio falls under that 2.5 lakh rupee ticket size? If you can give us some numbers there.
So the portfolio about 2.5 lakh rupees will be about less than 30%. Majority of the portfolio sits between 1,25,000 and 2.5 lakh rupees. And that also because in recently last 2 years, gold loan prices almost have doubled. So the ticket size have gone up only also because of that. The gold loan prices have seen a run in last 2 years, almost 100% jump have come. So we see that if gold loan prices keep pushing like this, I think more portfolios start shifting from beyond 2.5 lakh rupees, where we have to assess the income and underwriting of the borrowers.
Understood that. The other part of the PNL that we were looking at is the other income portion. It's growing at a strong pace, doubled on a year-on-year basis. Co-lending is something that has clearly aided you. Going forward, what will be the ideal mix for you? Do you feel as a proportion of the total income, co-lending will continue to grow higher?
So in the total income, there are various fee segments. There is income from sale of the insurance policy to our borrowers. There is a car loan which we sell for our third party product, being about 12 partner banks, where we sell. Last year we sold about 1 lakh car loan and generated a gross fee income about 240 crore rupees, a significant amount of income. So it's a huge focus that how do we deliver a ROE between 2 to 2.5% purely from the fee income, and that also differentiate others from our competition. So their fee income include car loan distribution income, insurance distribution income, and co-lending income. As regards co-lending, about 20% AUM sits in the blend is a very wonderful product where the low cost fund of the bank and collection efficiency and underwriting capability and the reach in the rural segment of the NBFC do collaborate with the lender, and ultimately customer also benefit. As far as the company is concerned, we need not to provide any capital for that.
Got it. Mr. Sharma, you briefly spoke about MSMEs as well. Just want to understand, is there any pressure point? Are there any pressure points that you are seeing in that particular space? Because that has been a concern, right, for lenders generally. Your credit cost, you said you'll remain at 90 basis points this year. Do you stick to that? If you can give us some more idea on what are the constituents that you're looking at to keep that credit cost at those levels?
So while generally speaking, this MSME segment in the unsecured have shown a lot of stress. And if you talk about the collateralized segment, in some pocket, in some profile where the tariff have caused those exports slowing down in the textile hub or the gems and jewelry and other aspects, in those clusters we have seen some stress going up. But barring that, in the collateralized segment, especially in the segment ticket size of 20 lakh rupees, we are not seeing much in, barring those clusters I mentioned are affected due to the exports is slowing down.
Understood that. So in terms of NIMs as well as ROAs, what is it that we should aspire for by the end of FY26 and FY27? How is it looking?
So 27 definitely ROE we are targeting not less than 4%, and which is visible. If you look at the quarter specific, our ROE had touched in that June. And despite the large amount of capital have come by way of QIP, we are able to reach a ROE in the range of about 15%. And I think next year will be much better. We should be able to target a ROE in the range of about 16.5% to 17% and overall ROE in the range of 4% plus.
Okay, Mr. Sharma, a lot more questions, but completely out of time today. But it was a pleasure speaking with you today on the quarter gone by, but most importantly, the outlook going forward for the company. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the market, stock-specific action, and get our mid-cap spotlight stock as well. Welcome back. You're still tuned into Midcap Radar. This is our special segment, Midcap Spotlight. Rachna is joining us now with all the updates coming in from Car Trade Tech. That stock is lower in trade today. Rachna, tell us more.
Now, this is a significant development in the consolidation story we've been tracking in the digital auto space. Car Trade Tech has issued a formal exchange filing providing clarity on its discussions with Girnar Software. Now, the deal won't be moving forward. Now, Girnar Software is the parent company of Car Dekho and Bike Dekho. Now, if you remember, on November 11, the company had confirmed that it was in preliminary talks for a potential consolidation of their automotive class fields business in India. And this was first reported by us a day before that, and the company later confirmed it. But now, if you look back at it, had this deal gone through, it would have brought together two of the largest online auto marketplace players in the country, and it could have created India's biggest auto tech platform. And there was good reason for that. Car Dekho's new auto business, which includes Car Dekho, Zig Wheels, Bike Dekho and Power Drift, are estimated to have generated around 3,000 crore rupees in FY25, revenue at 33% EBITDA margin. That's growing to nearly 3,700 crore in FY26. The group also fully owns its auto lending arm Rupee and holds majority stakes in Insurance Dekho and OTO, giving it a much wider financial services footprint in the mobility ecosystem. For Car Trade, analysts said that the rationale was scale, synergies and pricing power. The two platforms together command nearly 20% of India's digital auto advertising pool. That's according to JM Financial estimates. And based on the valuation math that was laid out in the same JM Financial report, Car Dekho's new auto vertical alone could have been valued at around 61,000 crore rupees, making this one of the largest consolidation moves in India's consumer internet space. But all of that now is on pause. Car Trade Tech has said that both the parties have mutually agreed not to proceed with the proposed transaction, and at this stage, the company has stated clearly that the discussions have ended without an agreement. This brings down the curtain, at least for now, on what could have been one of the most consequential combinations in the sector.
Well, that's right, Rachna, in a story that we're on top of. But now the management has decided not to go ahead. It'll be interesting to see, in the next conference call what exactly they say in terms of what made them drop this particular acquisition, given the kind of synergy benefits it would have brought about. Well, a smidge of a recovery in some select stocks across the broader end of the markets. Names like Delivery trading near the day's highest point. LTI Mindtree, that particular stock is doing quite well. IDFC First Bank, that particular stock has now surged and is now near the day's highest point. A quick up move on that particular name. Cummins India, another name our technical analyst on the show had said was looking quite strong on the chart. That particular stock too has now moved and up over 1% in the session. But the broader end of the markets continue to witness significant selling pressure. And if you look at the advanced decline ratio from the time we started the day off, it's deteriorated quite significantly and well in favor of the declines is what the advanced decline ratio currently is at. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra and with me is Vinny Motiwala. This is a show where you get your daily dose of mutual fund, investment strategies and a lot more. Hey Vinny, interesting discussion today and we have a lot lined up on the show for our viewers as well.
Absolutely a lot lined up on the show, but in the first segment, what we're going to be putting the spotlight on is going to be the flexi cap funds, right? Look at the growth that they've seen over the last few years. The amount of interest that actually comes in here is very great. Now, to talk to us about all of that, we have Swaminathan, MD and CEO at Geo BlackRock Asset Management, to talk to us about all of that. So that's what we'll be discussing. Sid, good afternoon. Thank you so much for joining us in the studios today. It's a pleasure having you here.
Yeah, thank you for having me.
And Sid, let's start by talking about flexi caps as a whole, right? As an asset class that comes in the mutual fund category, that's seen an amazing growth. October 2025, when you look at it, flexi cap funds overall, they accounted the flows were 8,900 crore approximately. Jan was just 5,600. So that growth has obviously been there. Now, given these sharp inflows in 2025, how should one interpret these flows and how does the allocation in terms of portfolio come in for investors here? How should one be looking at it?
Sure. Look, I think the way I think about this is there's always going to be times where a certain category or a certain sector is the flavor of the month or the flavor of the week. We all know this, right? But what's really encouraging for the flexi cap category specifically is that the consistency with which that has grown and the popularity of it with investors. And to me, it really signals that it's being kind of accepted and seen as the core equity allocation for everyone's portfolios, right? So, and that once you kind of have that mindset to say, okay, and I'm a big believer in asset allocation, so I'll talk about that a lot. But once you have an asset allocation in mind and you say, I need a certain percent in equities, and then within that, you have flexi cap as your core, and then you can choose the, let's call it the satellite allocations around that. That's a really powerful way to kind of build your portfolio, increase your wealth. So I think FlexiCap being at the heart of that is a really positive sign for all of us.
So when you say it should be a part of the core portfolio, of course, asset allocation can mean different things for different people. It's personal finance at the end of the day, so it's very personal. When you talk about it, say somebody's starting out fresh, they're first-time investors, and we're seeing that continue month by month in the mutual fund industry. How much do you think they should allocate to say, flexi-cap funds? Of course, it wouldn't be one answer fits all approach, but what is the general answer on how much flexi-cap should be as a part of your portfolio?
Yeah, it's a really good question, and we are very excited about the first-time investors. If I can take a minute, so we have so far in our 4.5 months since launch, gotten about just over 8.5 lakh investors. Of those, nearly 10% of those are first-time investors. So we're very, very close to them. And the beauty of, to answer your first question around the how to get started, is that you can get started with as low as 500 rupees in an SIP. So I think that's a great kind of mechanism for someone who's, let's say, not sure, to start just getting into it, see how the funds are doing, to learn more if they want to be kind of learning themselves, or they can seek kind of the guidance of an advisor to get more sort of notification around how to rebalance things. But I think that is a huge kind of enabler to be able to get in at such a small amount. Allocation, to your point, which I've talked a bit about, is a very personal thing, right? So depending on who the individual is, how old they are, what their goals are in life, that can differ a lot. So again, it comes back to the education. Either learn by yourselves, figure out how you want to do it, and then think about something like a FlexiCap as a core part of the equity, or go and get some advice from someone who can help you build your asset allocation.
It should be core, is the point, not a satellite part of the portfolio, FlexiCap for that matter.
Exactly right.
Normally when I started, it used to be like, oh, invest in large cap, that is where the safety net comes in. Obviously, FlexiCap does give the mix of all caps, and someone professional is managing it, so I don't have to keep worrying about it. In terms of returns also, over the past 5 years, FlexiCap, around 18-20%, while mid and small cap, where that excitement comes in, that's seen a bit of a higher return. So how does one actually adjust their portfolio? Do you need to do that? Or how do you move about with the mid and small cap and the flexi cap coming into your portfolio? And core means then avoiding or lesser large caps, or how does that work?
Yeah, sure. I'll try and answer that. So you're right. back in our, let's say, early days of investing, you would just think about large cap as kind of the core allocation. I think the one of the beauties of the kind of market and how it has evolved here in India is that the breadth of the market has grown tremendously over the last year. So in terms of the number of new companies that are coming to the market, getting listed has grown. And along with the breadth, the depth is also increasing. So more and more investors are looking at these companies and actually thinking about investing in them. And that's why you're seeing some pockets in terms of, small cap doing better, mid cap doing better. But overall breadth and depth is increasing. So that means that when you think about the core, your core can now be beyond just a large cap. And that's why I'm now saying flexi cap is what you should be thinking about as the core of equity investing. To your second point around how do you pick between the two, again, there are many ways to skin that cat, right? So within a flexi cap fund, you can let the fund manager make that decision for you, right? So again, there's the flexibility to go between the market caps, which is why it's called flexi cap. Or you can choose to do it yourself, right? And again, at Geo BlackRock, we've got funds, again, that are offering that kind of satellite exposure. So if you want to have one core and have a bit more exposure to small cap, a bit more exposure to mid cap, we have funds for that as well. So individuals can choose whether to kind of do it themselves. It isn't easy. Getting that call right, getting the timing right isn't always easy, but some people would want to do it themselves. Or they can leave it to either a fund manager through a flexi cap fund or through an advisor in terms of getting the right asset allocation and then rebalancing it in an appropriate way.
It isn't easy. That's why we have you on the show today to make it easy for our viewers, right? But when we talk about outlook on, say, sectoral rotation and how reallocation can be a part of your overall strategy as well across sector, that impacts long-term alpha as well, right? How does that work in the strategy when it comes to flexi caps? How often do managers actively think about making that churn?
Yeah, very interesting question. So in our actual flexi cap fund, we have a very differentiated strategy. So this specific fund that we have in the market right now, we are looking to generate the alpha really through stock selection views. So we're actually taking a lot of views because it's a data-driven strategy. We're using a lot of the technology to do that. So we're looking to generate alpha just by making calls on one stock versus another. So we generally tend to be pretty sector neutral in this particular fund. Now, we are planning in the future to launch more funds where we will be applying the same kind of data-driven approach, but to do sector rotation, because we believe there is alpha to be had in both. So you can generate alpha by selecting between, say, one stock versus another. You can also generate alpha by betting on one sector versus another. But the way we have chosen to kind of approach that is actually separate that in terms of having separate funds that do that. So this one is just focusing on securities. And then we'll be launching funds in the future that will focus more on sector rotation.
Okay, so sorry. So in that case, if we are focusing more on stocks, would that mean higher churn? Because the earlier conversation that we had as well, that indicated maybe because it's AI human managed flexi cap scheme for you, right? How does churn change things for investors in that case? Because they would like to understand more on that aspect as well.
Yeah, 100%. So yes, so the fact that it is data-driven means that we are able to capture, and when we say data, we're using data that is, let's say, more traditional, fundamental that you might expect, but also alternative data, which moves faster. So you can get insights faster on some of the stocks. So the turnover or churn is higher. But the way we're able to balance that is two ways, right? So one is the fact that I talked about earlier, that the overall breadth and depth of the market has increased a lot, right? So that already means that the ability to rebalance faster is enhanced in a strategy like this. And secondly, breadth, which means that we also have more stocks, which means that even though we're churning, the actual size of the trade in each individual stock isn't going to be huge. So it's not going to have a huge market impact on a single stock. So we are able to kind of, let's say, control our market impact, even though we have a higher turnover than most funds. And that's because it's enabled by this data-driven strategy and supported by the higher breadth and the depth of stocks that we have here in India right now.
Got it. Absolutely. Let's talk about the fund itself, right? The Flexi Cap Fund, around 2,200 crore AUM. So much of it, I think 40% of your AUM is coming from B30 cities. So in terms of the type of investors you're seeing growing now here, and what if someone wants to look to invest here, what is the strategy maybe you would highlight from Jio BlackRock's point of view?
Yeah, sure. So starting with your initial point on the investors themselves, right? So you're right. So it's at about 2,200 crores right now. We did close to 1,500 at the NFO. So nearly 50% has come in after the NFO, which is a really encouraging sign for us. And the geographic split is very, very encouraging. So the fact that, as you said, 40% of the AUM came from beyond the top 30 cities is super encouraging, because that's really what we are here to do. We're here to bring more people into the market, convert more savers to investors, access the areas where there isn't that much access right now of mutual funds. So that's a really encouraging stat. It's early days. We're still under 5 months old, so it's early days, but it's a really encouraging stat for us to look at. In terms of the how, again, we have seen the full spectrum of investors taking part in the FlexiCap fund. So we have nearly 680,000 investors in the fund. And that is all the way from your deep mass retail doing 500 rupee SIPs to also some institutional tickets. So it's really, as I said at the start, an all-weather fund that caters to kind of the entire investing population of India. And the fact that you can get started as low as 500 and do it consistently through the SIPs is a great enabler for investors here in India.
You have launched a FlexiCap funds. July was a season of liquid funds coming in from Jio BlackRock, right? What is in the line or the pipeline right now? You have received some approvals. It is in the pipeline as well. If you can just, I wouldn't of course ask you greater details on that. That is not something I can talk about. But what are some products you think are needed in the market and will be given by Jio BlackRock?
Yeah, absolutely. I won't get into any of the product details here right now, but yes, we have gotten approvals for 4 more funds, which we'll be looking to launch over the next few months. But taking a step back, the kinds of products that we want to bring to the market here, and we have, a couple of lenses that we apply to it. First, that the product has to, deliver a value proposition for a certain segment of the investing population. So whether it's a institutional focused products, for example, our liquid funds that we first launched, or more of the retail product, for example, the FlexiCap that we launched more recently. So it has to have a value prop as a fund for a particular segment. So that's really important. And then when we come to the fund, we look at what's already available and make sure that we are delivering something that's unique and differentiated. Now, we recognize that the market as it is in a growth phase. We've come a long way in the last 5 years, but I still think we're only scratching the surface. I think the next 5 years we could double from here. So the growth potential is there, but there are almost 50 other AMCs here with funds in each of these categories. So we look at the category, we say, what is it can we bring that is differentiated from an investment style perspective, from an access perspective, from a cost perspective, that really can stand out and deliver something different to the client. So that's the lens that we're applying. And that's the theme that you will see kind of coming out over the next sort of 3 to 6 months as well.
That's going to be interesting, right, to watch for all of them in terms of the themes as well, including different kinds of funds that you all are launching from what you all already have. So thank you so much, Sid, firstly for joining us on the show, giving us an explanation in terms of FlexiCap fund, the industry-wise, what's the growth there, and infos there as well. Thank you so much for joining.
Thank you for having me. Cheers.
And viewers, we're going to slip into a very short break. Don't go anywhere. We'll be back with more on the other side.
Welcome back. You're still tuned into MF Corner on CNBC TV 18, and it's just not about investments and other aspects of asset class, right? There is a lot that's happening in the mutual fund industry, and that's exactly what we want to address. So let's talk about the top news that we've seen or we've heard recently. First up is veteran fund manager Roshi Jain has exited HDFC AMC. When you tell us more on that, the track record, and what kind of journey has she seen?
Absolutely, like you said, and a veteran actually coming in here with the name that she has as well. So obviously, 4 years after being at HDFC AMC, a very strong performance that she's delivered across the key funds that she'd been managing as well. She's finally said that she is moving on from there. Now, she took charge of HDFC FlexiCap Fund that was around in July 2022. That was succeeding the former CIO, that is Prashant Jain. During her tenure there, Roshi actually managed 3 flagship funds: HDFC Focus Fund, HDFC FlexiCap Fund and HDFC Saver Fund. And all of them have seen impressive returns. You can see it on your screens as well, right? All in the range of 21 to 23% versus the category average. Now, when you're looking at it in the last 3 years is what we're looking at, the CAGR returns for all of this are at 21.9%, 22.3%, 21.6% respectively. Significant outperformance, like you saw it, versus the category average, which is around 15 to 16% for all these funds. Look at the AUM, right, that she's managed. 1.33 lakh crore as of November 2025 was the AUM of all these 3 combined. When you look at the Focus Fund, 25,000 crores, FlexiCap, 91,000 crores itself was just that FlexiCap Fund, and Tax Saver was 17,000 crores. So that's the total AUM she was managing. And before HDFC AMC also, she had spent nearly 17 years at Franklin Templeton, and that's 2005 to 2021. And her journey has been fantastic. She started as an analyst where she's moved up and then managing funds. So that is a great journey that she's had over there. Before that was at Goldman Sachs, where she was a financial analyst as well from 2002 to 2005. And she's handled on the Asian side of retail stocks in Singapore as well as Hong Kong, and a European building material side in Goldman Sachs is what she worked on. So this is a key departure that's coming in HDFC AMC, where investors were keenly watching out for now what's going to be happening here in these funds.
Oh,
Who
yes.
comes, takes over, that's going to be the key as well.
But of course, because it's an active fund, right? So the fund manager matters the most here as well. So we'll watch out for that. But that's about HDFC AMC and the big change there. But let's talk about PPFAS Mutual Fund as well, because this is one of the AMCs that actually holds unit holder meets, which we don't see otherwise in other AMCs. They held their 12th unit holder meet over the weekend, and they laid out the roadmap for coming years as well. The first one, of course, is they're planning to launch a large cap fund in 2026. That's as close as Jan 2026. That's new because it is a category which is largely out there in the industry as well, right? It's not a new product, so to say. But yes, they are going to do that. The second is they'll be setting up a subsidiary to apply for license under PFRDA to operate under the National Pension Scheme framework. So that's a new retirement product that they're looking at overall. And they're going to expand global access through operations in the gift city. So some more ways of exposing yourself to the US markets as well. In terms of the investment criteria, when it comes to the global markets, they talk about how they only have selective global giants in their portfolio. They're focusing only on the ones which are cash generating, they are not high risk, and high burn AI disruptors as well. They also spoke about an IPO, and they said they could look at it by 2030. More details on it, of course, is something that we'll be watching out for. But PPFAS MF is the one which has the highest cash levels in the industry, 22.2%. That's the highest by a margin, because the next one is Quant MF, 11.8%. We also have Capital Mine MF, but it just came by. So of course cash levels are expected to be high. But we have White Oak MF with the cash levels of 11%, Motilal Oswal AMC at 7.2%, followed by HDFC AMC at 6.3%, Trust AMC at 6.1%, Bandhan AMC at 5.7%. So it is a huge margin by which they have cash in their portfolio. They had indicated earlier that they are still looking for opportunities to invest that cash into, not finding those opportunities yet. So yes, this is the analysis as far as PPFAS schemes are concerned. Very interesting, considering that there is something new which comes out of every unit holder meeting there, and this time it's the large cap NFO launch.
We'll be keeping an eye on that, and we'll keep you all updated with that as well. But More news flows or NFO openings that we've seen come by this week is one, Navi AMC, that's their Nifty mid-small cap 400 index fund is what they've opened up. You can see it on the screen still, 5th of December. DSP Mutual Fund has come out with a Nifty mid-cap 150 and small cap 250 fund as well. So that is something. Tata AMC, Tata Asset Management, that is, they've unveiled the Titanium SIF side of the fund as well. So SIF, that is also coming into play now. And obviously, Geo BlackRock in recent news has, mutual fund has received the SEBI's nod to launch 4 new active funds. That's going to be Geo BlackRock Sector Fund, Low Duration Fund, Arbitrage Fund, as well as a Short Duration Fund as well. So a lot of updates, Sonal, that have come in terms from other news flows as well. And all these new funds, NFOs coming in, everyone has to keep an eye out on that as well.
Okay, all right. With that, we'll do one thing. We'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
Lines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
the Hang Seng being the only outlier here. It's down 0.3%, but the Taiwanese index is up 0.6%.
Markets are reassessing the prospect of a potential Russia-Ukraine peace deal. 26,261 on the Nifty. The Nifty Bank is up about 0.13. The Sensex is up 0.16.
We've got some earnings acceleration as well in this quarter compared to what we've been witnessing over the last few quarters.
This has been in the making for a long, long time. Painful wait going back to September of last year.
The company as well as the Gujarat state government have reached an in-principle agreement.
India is the third largest resource for this rare earth ore.
Given the momentum which we are seeing, this year we should be able to maintain a growth rate higher than the industry.
Well, bulls are charging ahead. That's the theme, of course.
Nifty Bank has been a big contributor to this move. The index at record highs nearing 60,000, up almost 10 to 12%.
So you're right, there's been somewhat of a give back in performance relative this year.
Well, after touching record highs, there's a massive profit booking that's taking place.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Rima, with me Surbhi, Prashant and Nigel joining in. Well, it's a milestone day. The Nifty, after 14 months, conquered, surpassed its previous peak, went on to hit levels of 26,100. The Sensex inched past 86,000 mark for the first time ever, but you just don't get the feeling that the bulls are charging ahead. It's been a bit of a choppy session in the second half of the trading session. We dropped into the red and now trying to, climb and fight our way back. So the Nifty's managed to climb above 26,200. So we've got flat moves across the indices. Hi guys. I guess it's the Sensex monthly expiry plus US markets are shut today. And then, of course, profit booking, right? Every time you get to those high levels, you can always say there is that fear of heights. We were discussing this in the morning, that it doesn't really feel like an all-time high. It is an all-time high day. Didn't quite feel like that. One in the morning, and the second half, dare I say, has turned out to be a little disappointing because you'd want momentum, you want participation. That's been missing.
Close at the highs,
yeah,
right?
Yeah.
Rima, those in Santa colors.
Between the green and the red.
December and Santa now.
Actually, we're all red, white and green.
At the beginning of the month. On Monday, you were talking about year-end rally, year-end, and, volumes quietening down.
Disappeared.
Red, white, green.
One more stat, Surbhi, that out of 500, NSE 500 companies, I was just looking at last time the Nifty made a high, which was September 27, 2024. Only 170 stocks are even higher. And actually, it's about... if you look at stocks which are up over 2% in the same period, high to high, there's only about 130 odd names out of 500. So, and that is, you can look at this data point, but to make the same point, this point essentially being that indices are at new highs. It's been like that, right? Hanging near highs for a while, whereas the broader market has been struggling a bit. Nigel is with us as well. Nigel, afternoon.
I thought you forgot about me, guys. Those Christmas colors and all that. But, not a bad session, guys. Come on. I think it's okay. Par for the course. Normally, when you see a fresh all-time high, you see some kind of profit taking. But otherwise, it's pretty okay, I think. So the Nifty Bank is leading the way. The VIX has cooled off and the PCR as well has cooled off. So let's see whether or not we can build on to the gains from here. And the point that we've been making all through the day, it's not feeling like all-time highs. Time for the broader markets to start performing. And Pankaj Chibriwal, he joined earlier, and he said, in fact, in the past quarter, yes, the Nifty earnings were okay, but from the broader markets, actually, there were some green shoots with a higher amount of revenue growth from the broader markets in particular, and better earnings growth as well. So if the pieces have to come together, then hopefully the broader markets do participate as well.
Okay, well, yeah, indeed. That's the shape of the day. Let's actually move on, tell you what we've got lined up, and then we'll get to the trading calls as well. It has been a record high for the Sensex and for the Nifty after a 14-month struggle. But the stocks have given up gains from the highs, so it's a bit of a quiet session as of now. Flatline for the key indices. The other big story, the cabinet has approved a scheme to promote the manufacturing of rare earth magnets in India and reduce the import dependence. We spoke with, of course, the companies involved, and Parikshit will also join in to tell us about the likely contours of the scheme and when it's likely to be notified. Mahindra is celebrating a year of its Born EV platform with the launch of the mass market 7-seater SUV. This is an EV again. It's the XEV 9S. Can it, spark the fortunes for M&M once again? We'll find out. The management also talks about their EV segment plans overall. Whirlpool is another stock in focus. Promoters have sold over 11% stake, which is valued at about 1,600 crore rupees. More on this very important deal coming up.
And of course, we'll start off first with the trading strategies. As always, Mitesh is joining in. Mitesh, and we've been discussing this since the morning as well. And I remember your morning call very, very clearly. And you'd said this, that expect some profit taking once we hit these high levels. And you had said that only if the Nifty decisively crosses 26,300 will you initiate fresh longs. Are you sticking to that call?
I think that's a good way to approach Surabhi because, we did get past 26,300 by about 10 points, but no sustenance over there and immediately kind of started tapering off. So I think till you get a, closing about 26,300 would be definitely welcome, but at least some kind of a burst about 26,300, I think that will convince me that the market is ready to get into higher levels and possibly build upon the up move which we have seen for last couple of weeks. Having said that, therefore, since we have not had that event, I think on the trading side also what we'll advise is to possibly reduce some kind of long exposure, even on the stock side, and identify some shorting ideas. So I have one buy and one sell. On the buying side is Motherson with a stop at about 112, look for targets of 121. And Oil India is a sell with a stop at 422 for targets of 405.
By the way, some metal stocks are now fighting back. JSW Steel is back in the green. Hindalco is pushing towards a 1% gain. So some recovery and up moves seen in these metal names. But let's talk about the other big story. One day after the government announced a rare earth permanent magnet manufacturing scheme with an outlay of 7,300 crore, CNBC-TV18 has learned that the government may move fast to operationalize the scheme and invite bids. The aim is to build long-term capacity for rare earth magnets, which is currently almost fully imported into the country. So what could be the contours of the scheme? What's the government thinking? Parikshit joins in with the exclusive details. Parikshit.
Well, the government wants to get down to business when it comes to setting up a domestic supply chain of rare earth permanent magnets as soon as possible. We believe that now that the scheme has been announced, the notification of the scheme could come out in just about 15 days. And post that, the government would like to invite bids by 31st of January 2026. This is what we're picking up from our sources. Interested bidders, we are told, will have to submit a detailed project report along with their bid applications to show that they have some sort of expertise in making rare earth magnets. And even if they do not have expertise, they have the global tie-ups or some sort of past manufacturing experience which will help them in making magnets in the country. At the same time, they will have to show the financial capability as well. In fact, having an ability to invest at least 1,500 crores in setting up a plant for 1,200 tons of magnet annually may be one of the criteria. The government may also invite smaller companies which can set up plants for 600 tons of magnets per annum. They too may be invited. Very soon, an inter-ministerial group consisting of 10 ministries is going to set up. They will be supported by India Rare Earth Limited, Bhabha Atomic Research Center to come up with a criteria which all the companies who are bidding for this scheme will have to follow. Companies are free to have global tie-ups. They can have a technology partner from abroad, but they must manufacture in India. That is going to be the base criteria. We also believe that during the consultation phase, when the scheme was being worked out and discussed with the industry over the last 3 to 4 months, at least 25 companies showed interest. How many finally go ahead and apply for this scheme? That remains to be seen. We're told by sources that at least 3 companies in India, Intellis, Ashwini Magnets and Midwest, have an ability to make rare earth materials in the country. But we definitely have to boost the refining capacity in a great manner as well. The government is also asking the Department of Atomic Energy to tell India Rare Earth Limited to expand its capacity of making NdPr oxide, which is a crucial raw material of rare earth permanent magnets, so that they can be a big input and raw material supplier to the domestic industry.
Okay, all right, got that, Parikshit. Thanks very much. Important story that is playing out over there. In fact, we had caught up with the Indian rare earth company itself, as well as IMFA, India Rare Earth Limited and IMFA, and they're the big public sector miners for these rare earths. IMFA is a private sector player, and they told us that they will look at the contours of the scheme very, very carefully, and then they decide whether they want to get into the manufacture of the magnets themselves. Listen in to both the companies.
India is the third largest resource for this rare earth ore. So currently we are having 8.35 million ton of rare earth. So for this, but this is lighter rare earth. So lighter rare earth, particularly NdPr we are having, but we require dysprosium and terbium, which are required for the this coercivity or to have this high remanence, which allows the retain high magnetization and the coercivity in the magnet. Right now, this dysprosium and terbium has to be imported, and on top of that, there are technology available like Protorial and this VAC of Germany. They are having this technology of making rare earth magnets without using the dysprosium and terbium.
We, of course, have decades of experience in mining, in processing of ores, etc. Now, I do recognize this is a different cup of tea. Conceptually, it may be similar, but it is a different cup of tea. But inherently, I would say that we are amongst the few who understand it off the bat. And it's a question of going out and evaluating the details when the scheme is out in the public domain, as it is at the moment, going through the details and looking at what is there on offer. But off the cuff, I would certainly say that it is a great opportunity. It is something that we would certainly want to evaluate and see that how it fits in to our own sort of capabilities and strategic ambitions.
Okay, so that's a word from IMFA. But, like India Rare Earths Limited, like Mr. Mohanty explained, there are still lots of tech issues that need to be sort of cleared up. The availability of raw materials, the actual materials with which these magnets are made, the actual rare earths, that also needs to be sort of seen. In any case, we have Deven Choksi of DR Choksi FinServe joining in to take a couple of questions, talk about some interesting stocks. Before I get to anything else, Deven, hi. Good to have you in. And, I think congratulations to all of us, to all the investors. We've finally seen the all-time high for what it's worth. But let's talk rare earths. It's obviously a very interesting subject. The question is that in the market, there are few stocks. I mean, you can go back to a GMDC. GMDC has already rallied some 70% this year. And like India Rare Earths was explaining that the actual elements which go into the making of these magnets, for that, the feasibility studies are still going on. They need to see if, there are enough deposits in Rajasthan and, elsewhere. Now, is it worthwhile to play a stock like GMDC, or should one just stay away? Do you think it's a very volatile area right now, this whole rare earths piece?
Yeah, hi, Surbi. Good afternoon, and congratulations to all of us. I think we'll have to develop the habit of, congratulating each other every time, because I think this market is showing the signs of going up to 32,000 to 33,000 Nifty in a span of around 12-15 months. So hopefully,